This conference will now be recorded.
Let us see. There are only 5 participants as of now because there is a net issue in Western suburb of Bombay. So many people
Right,
are
sir.
unable to join.
Same was the case at my end too. I was having a lot of difficulty to join in because of the internet issues. In the meantime, sir, can you also give us rights to share our screen, please?
That CA issue से WRC से कौन है? WRC?
हाँ सर बोलिए।
अरे बॉस दोनों सर को शेयर स्क्रीन दे दो ना, विनीत सर और साहिल सर को दोनों को दे दो, शेयर स्क्रीन दे दो।
सर दोनों एक 1 by 1 चलेगा सर। तो दो जन
तो किसको देने का?
विनीत सर, साहिल सर आपको दे दिया मैंने। साहिल सर।
No, I will share the screen, no problems. But since
I suggest Sahil, since your internet is weak, let me share the screen.
Yeah, makes sense, Vinit.
Yeah.
तो विनीत सर आपको दे दो। विनीत सर।
हाँ विनीत सर को दे दो।
मेरे को दे दो, करेक्ट।
ओके आपको दे दे रहा हूँ। तो अब दोनों जन का एक ही साथ में हो जाएगा कि अलग अलग देना पड़ेगा?
नहीं एक ही साथ।
नहीं दोनों एक साथ हो जाएगा।
ओके। और अतुल सर मैं आपको ऑर्गेनाइजर बना दूं, चलेगा? अगर मेरे यहाँ पे नेट का कुछ इशू होता है तो आप देख लेंगे, या फिर आपके यहाँ पे कुछ होता है मैं देख लूंगा।
देख लेना, मेरा भी जरा 2 प्रोग्राम चल रहा है यार। अरे मेरा 2 प्रोग्राम एक साथ चल रहा है यार, मैं तो आ नहीं रहा था। मेरे को अभी हेमंत भाई बोले वो नहीं आ रहे तो मैं आया। मेरा दूसरा भी एक प्रोग्राम चल रहा है, मैं एक जगह और लेक्चर दे रहा हूँ।
आपके यहाँ से ना है?
मेरे यहाँ से आ जाएगा, ठीक है।
Is everybody able to see the screen?
Yes sir, we are able to. Yes, sir.
Yeah, Vinit.
We'll wait for people to join. There are no 1 2 3 4 और no. आप ले लोगे क्या फिर बायोडाटा? मैं चालू कर दूं? वो आए नहीं कोई। नहीं आए, 10-12 जने तो आए हैं, ठीक है। हाँ मेरा ही वेस्टर्न सबर्ब ही है सर, मैं भी अंदर में हूँ। हाँ वो बोरीवली में है, उनका इशू है, ठीक है। तो आप मुझे व्हाट्सएप पे भेज दो ना, ये बायोडाटा किसी एक का भेज दो ना, दोनों भेज दो, मैं दोनों में पढ़ लेगा ना उतना टाइम चल रहा है। तो व्हाट्सएप पे भेज दो ना सर, मैं दोनों में बैठ हूँ। Please unmute yourself, other participants, please unmute yourself. So since it is 4:05, I'll wait for another 1 minute and we'll start the proceedings.
Sure. Anyone in the western suburbs who of late were able to join now when were facing issues, internet issues earlier, so that at least we get some confirmation as to things are better that side?
I am there from western suburb only, sir.
but Atulji, you were able to join in earlier also, right? But we mentioned that there were a few other colleagues who were wanting to join in, were facing some internet issues.
I know the colleagues. I can see.
Okay.
People have joined, but
the problem is in Borivali and Kandivali.
Kandivali. Correct.
The members are coming from that area only, so there is some issue of internet, and Jio as well as Vodafone network is not working.
So why don't you postpone it tomorrow?
Tomorrow we have no place, sir. Tomorrow there is no place vacancy in. There is no time allotted to us, sir. That is the issue. And tomorrow we don't know what will happen tomorrow also. Our timing is fixed this only.
3-4 days time, so that is the issue. Till Sunday it is a problem.
People are not there. Then what you will do? What is the fun of having a meeting?
The video recording is available on our website, so other members you can give the video recording. Since the guest speaker are already there, we'll start with the proceedings. Welcome all to this study group meeting of the WIRC of Western Zone. As usual, we are having every Friday, once in a month, 4 to 7 speakers on various topics of interest related to IBC. Today, the topic covered is valuation, and we have got speakers from RNC firm based out of Mumbai, Delhi, Vadodara, Ahmedabad, etc., and 2 senior partners from the firm, Mr. Vineet Rathi and Sahil Aruna, are there to take up into the integrities and details about the valuation. So I'll briefly introduce both the speakers of the day, because I believe both are speaking jointly. So I'll introduce both the speakers of the day, and they can take over the proceeds thereafter. So Mr. Vineet Rathi is a partner in RNC Valuechem LLP, and is a fellow member of ICAI, and has already additionally pursued qualification of information system ISA, and a registered value with ICAI RVO registered with IBBI. He carries with him immense knowledge of field of finance and valuation, both in domestic as well as international space, restructuring, financial management, due diligence, auditing, and assurance. He has over 20-year experience in the field of financial services and infrastructure, including 2 years plus experience in leading consultancy company. His extensive experience with various types of industry, large and small, enables him to understand different industries and business. The understanding of the business gets translated into out-of-the-box solution and value-added service to the clients. He has been on the board of some of the infrastructure companies with interest in power and road infra projects. I'll briefly introduce Mr. Sahil Narula, who is also a partner with RNC Valuers LLP. He is the 3rd generation entrepreneur at this firm, and he has been instrumental to leaping the firm from valuation for the IBC purpose. Under his leadership, RNC valuation services have grown exponentially in terms of lead size, international quality of reports, client base, and geographical location. Today, RNC is the preferred consultant for the best industry in the country. The firm having 3 decades of experience in the field of valuation. Regarding Sahil, who is a BA Mechanotrics from GCT College, MBA Family Managed Business at SP Jain, Master of Valuation at Shivaji Nagar University, Advanced Corporate Finance at IIM Ahmedabad, and Registered Value for Plant and Machinery. And he's a member of INSOL. He's a member of National Council, member of SOCM Committee on IBC and Valuation. He's a member of CIA Special Task Force on IBC. He's a member of Indian Institute of Valuers and a member of IOV RVF. With this brief introduction, I'll just touch upon that the valuation is a very integral part in both the process of resolution as well as liquidation. So the topic for the day shall be interesting, and what are the points that are covered. I would like Sahil and we need to cover especially the investments that are made in a subsidiary company of a real estate or infra project, how the valuation is done, and how to, because that is a very critical thing I am also facing as of now today also. I am running a process where there are around 10 subsidiaries in the company. So I would like myself to get enlightened on that also, and other members also. With this, over to you, Sahil.
Thank you so much, C. Atul Jain, for the great introduction, and thank you so much, C. Hemant Mehta, for introducing us to this quorum, as well as C. Praveen Navandar, to introduce us to this forum, and also thanking Chairman WIRC Manish Gadia, CA Manish Gadia, to give us this opportunity to brief everyone and discuss with everyone on this August gathering. First and foremost, am I clear and audible? Because this is the first question that comes to my mind,
Yes, Sahil,
especially with
Yes.
both. Yeah.
Okay, great. So let's start, I think, with some questions, so that let's start getting started with one question. So I want to throw out some numbers, and I would want you to tell us the relevance of those numbers. Okay, so the numbers are 130, 100, 77, and 63. So does these numbers make any sense to anyone, and can anybody throw some light what these numbers are referring to?
Sahil, maybe the figures of valuation given by different valuer for a particular kind of same property. In relevance to this meeting, I can reply this thing only.
Very relevant guess, sir. Yes, I mean, could be an alternative, but not the right answer. Anybody else has any guess on this? Okay, Kairav Trivedi mentioned these are IBC sections. Unfortunately, not Kairav. Anything else? So we have 2-3 members who are participating and wide awake and available for the webinar. What about the others? If you have any guesses, you can throw anything at us on this. Okay, so I think without much ado, I will share what these numbers are. So these numbers 130, 100, 77, and 63 respectively are the rankings of India in ease of doing business from 2016 to 2020 respectively. So what has happened, what has transpired post IBC is that India's ranking considerably has notched up almost 100% from 200 in 2016 to the points of 130 ranking to 63, which is the last dated ranking in 2020. And I think first and foremost, we should give all of us who are here part of the entire IBC ecosystem a big round of applause and pat on our back, because we have done something good for the country, as we are all very integral part of this entire ecosystem of IBC, which has primarily helped us as a nation to notch up these 60 odd ranks and show to the world that we are getting substantially better in terms of ease of doing business. So first of all, I think a big round of applause to all of us and a big pat on our back for all of us. So
Sahil, I was partly right. I was partly right by saying that it is just a country's rating, not a property rating.
Correct. So, but it's great to be part of such an ecosystem wherein we can contribute and see tangibly the results being forecasted in the ease of doing business, and our country climbing up the ladder of ranks and doing better by each year passing. So having said this, what IBC has done to us all professionals and specifically to us as valuers is what we will speak today. So IBC has given us valuers ROE, and it is not return on equity here, which we are talking about. While we don't disagree that it has given us valuers also a good return on equity, but ROE here today stands for R is the responsibility. So the code vests a lot of responsibility to the valuers to make sure that they give a valuation which is very thorough and clearly depicting the current state of affairs of the company, the health, and translating into the value in the fair and the liquidation value as determined by the code is what R stands for. O stands for opportunities. 4,300 odd cases as we speak have been admitted into IBC, and for as per the code, every case is mandated to have 2 registered valuers being appointed, and hence what we see is that 4,000 odd into 2, 8,500 odd total cases have been admitted. 8,500 odd valuers have been appointed in lieu of the cases which have been admitted in IBC. So that is a great opportunity which all the valuers have got by virtue of this IBC code. And third is the E is the equality or the kind of recognition which has been given to the valuer as a professional, and hence with this the valuer is empowered. By this empowering a valuer, also the responsibility is given on the valuer to make sure that the decision of the resolution or liquidation is going to be taken by the COC and the resolution professional, and hence to make sure and ensure that a report self-speaking and the detailed one is made available to the COC via the RP, so that due decisions can be taken thereupon. So let us quickly glance through how IBC has panned out, and as per the latest newsletter by IBBI. So we see that out of the 4,000 odd, 1,785 odd cases have been predominant in the manufacturing sector. This manufacturing sector is further broken down into various sectors. About 20%, which is about 850 odd cases in real estate and allied construction activities as well. Construction here also includes, of the 450, also includes EPC companies, which may be probably lower in number but higher in value. However, these are the numbers which are given in terms of the total number which IBBI mentions. So what this generally shows us is that how IBC as a country has panned out, which are the sectors which have had more stress, and how has been the journey as far as the number of cases is concerned. Going forward, next slide please. Yeah, going forward, just to quickly appraise, there are 4,000 odd registered valuers. The data is all available to all of us. Next slide, Vineet. And there are obviously different asset classes. Along with these valuers, there are also registered valuer entities, we being also one of them. We are registered under all three asset classes. Similarly, there are others who are registered amongst 1 or 2 or 3 or depending upon, and this is already mentioned here, and total about 40 entities as opposed to almost 4,000 valuers, with almost 1%. But this is the kind of state of the valuation ecosystem which is prevalent and at present available in our country at this point of time. Next, please. So the idea today is to, our experience in IBC, just to give you some background. So we have done over 125 cases in IBC, and total debt excess of about 3.5 lakh crores plus, and few large and notable companies in which we were part of valuers, Reliance Communications, and the entire, in fact, gamut of Anil Dhirubhai Ambani group, may be RCIL, RTL, RITL, Reliance Naval. The entire bit about the entire company valuations were done by us. We were also the valuers for the entire consolidation of Videocon group. There were 13 companies in Videocon Industries and Telecom, so on and so forth. The news of recently, its resolution have been out in the market. Uttam Galva, Uttam Steel, Bhushan Energy, IVRCL, Punj Lloyd, HDIL, so on and so forth. So we've been part of a lot of valuations, and today the idea is to share our experience as a valuer and discuss the points which have been our findings during the course of these 125 plus cases, and have a discussion on those, so that we are able to understand and appreciate the perspectives from both sides of the table, the valuer's perspective as well as the resolution professional perspective. And because the cohesive efforts of both the valuer and RP together only result into the maximization of value and the betterment of the value, which is ultimately the intent of the code, which is specifically laid down in the code. So IBC framework primarily divided into 2-3 various parts, in which the valuation services are also taken. CIRP, the most common and the one that we will discuss the most in detail today. Second is also voluntary and CLP, both liquidation scenarios. PIRP is, again, we will just touch base upon it, not dwell too much in detail since it is new, and we would like to focus today more upon the CIRP process as a whole. So under the CIRP process, under regulation 27 and 35, the appointment of valuer is mandated. Vineet, next slide please. And here, after the valuers are appointed, within 7 days of appointment and confirmation of a resolution professional, and then the resolution professional, after the formalities of no conflict of interest, so on and so forth, the engagement starts, and post which the submission of the report happens, and the entire steps we will go through it one by one in detail, more towards the valuation specifics and methodologies, also taking cognizance of point which Atulji has already mentioned in the due slides. Next please. So here, first and foremost, under regulation 35, there is a point number B here, which mentions that if there is a significant difference in the estimates of the two valuers, then in that case a resolution professional may appoint a third valuer. So now here we would like to stop over here and dwell upon this point and just share with us, share with you our experience which has been on this specific point. Now, first and foremost, significant has nowhere been quantified, but and that too difference at what level? One difference is at asset class level, second difference is at fair value level, third difference is at liquidation value level, or it could be a combination of any of these two, three. What we have seen is that there have been cases wherein overall value is same and similar, however internally asset class values have been different, and a combination of all these three have happened. But by and large, in general, the thumb rule which has been accepted, which we have seen as our in our practices, is that about 20% plus or minus difference on the liquidation value, primarily because the decision of accepting or rejecting a plan primarily is upon the liquidation value, and hence in our experience what we have seen is 20% plus minus. Again, it's specific, it is not mandatory, it is only our experience which we are wanting to share based on our experience of the valuations being carried out. 20% plus minus on the liquidation value is what we have seen is generally an acceptable range which the COCs and the RPs are taking into consideration as part of this significant difference over here. While we discuss, we will be very happy to hear a point of view of any of the participating members, and have any discussion on any point. Please feel free to chip in any point of time and discuss any point which you may feel deemed fit at that point of time. Next, please.
Sahilji,
Yes.
I just wanted
Yes,
to know whether you have been appointed as a third valuer at any point of time in any of the CRP as on the date. Third
Yes,
valuer,
sir.
not
In fact,
first and second, third.
yes, there have been several cases, sir. I would not say several, but about 5-7% of the total cases that we would have done. So about 8-10 cases we would have been appointed as a third valuer, sir. Yes.
Okay.
Don't you think that it should be 10% difference? It should be significant difference, not 20%.
Sir, actually, this is very. Yeah, Vineet, sorry, you were saying something.
No, so as Sahil mentioned, since it is not clearly mentioned in the code as to what is significant, it is left upon to the COC and the RP to decide. But however, what Sahil was mentioning is that is the general practice that is being seen in the IRP practice as such.
Okay, thanks.
And sir, we have seen cases where 25 has also been accepted and 15 has also been rejected. So again, these are specific, and we have also seen cases where say fixed assets or tangible assets were valued at 100 and intangibles were or financial assets were at 100 and were at 50. So total value being 150 and the other value being exactly the other way around, but total value again total being 150. So COC has taken a call saying that specifically for tangible and specifically for SFA there is a lot of difference, and hence appoint the third valuer. So we have seen cases across all these permutations, combinations, wherein a COC, again, court specifically mentions that it is to the commercial wisdom of the COC, and taking that comfort, as Vineet mentioned, the broad sense and general acceptability in the market is 20% plus or minus. However, there can be cases which can be significantly different, either upwards or downwards on both the tangents. Yeah, Vineet, next slide, please. Similarly, liquidation rules also entail appointments of valuers in the same regulation 35. However, there is a slight difference, is that under the CIRP scenario, a valuer is supposed to give one fair and one liquidation value. However, in the CLP scenarios, there is a to F under regulation 32, in which there are different various modes of sale which are specified, under which a liquidation professional might liquidate the assets. So we will just give few examples as to what we have seen and how we have seen and how a valuer looks at these scenarios and interprets it, and we'll just run you through, and we'll be happy to take your interpretations and views on these as well. First, assets on a standalone basis. Now, assets on a standalone basis necessarily entail piecemeal valuation. That means that you are not looking at a entire unit as a whole, but you are looking at it as parts. So here what happens is that, say for example, there is a manufacturing unit, and then if you break it down into smaller plants, just for an example, say it's a power plant. Now if a power plant needs to be broken down into a turbine and a boiler and say balance of equipment, 3 different parts, then obviously there may be a deterioration of value, because you may want to sell it in isolation and hence break it down into part and not selling it as a whole as a power plant. However, so then in that case your value may be lower in a standalone basis as opposed to a corporate debtor as a going concern scenario. However, in a case of a standalone asset like an office, for example, we had seen there was a case in which there was one headquarter of a corporate debtor which was very located at a very prime location and very well to do, well made headquarters. However, nobody is going to buy a 100 rupee worth headquarter which is a very good asset and take a baggage of say 2000 rupees of the other assets of the manufacturing locations. However, in such scenario of standalone basis, these assets or these types of assets may realize a better may have a better realization as opposed to a going concern scenario, because here you are not having a baggage and collective sale of the entire assets is not happening. However, it is happening in isolation, and hence on a standalone basis, this kind of an office or these kind of assets which are isolated or are differently identifiable and sellable in a different scenario may have a higher realization upon being sold in a standalone or a piecemeal basis. Second is the assets in a slump sale basis. Slump sale, let me just take after corporate debtor. Corporate debtor as a going concern necessarily entails that you look at the entire company of the company, entire at a company level, corporate debtor being as a going concern scenario, and slump sale is nothing but a discounted value, however not apportioned. So slump sale is a lump sum value. Say for example, I have fixed assets of worth say 100, financial assets of worth say 25, and total value sum of parts comes to say 125. Today if I want to go and bid, I would say I will give you a lump sum amount of 100. Now today this 100 is not apportioned or allocated specifically to fixed assets as whatever percentage of 100 and balance as whatever percentage of financial assets. However, it is a lump sum total overall value, but in a going concern scenario. So this is nothing but a discounted slump sale scenario in which a value would be lower than a going concern, and it will be higher than a standalone basis for a manufacturing kind of unit. Set of assets collectively. So just to give you an example, we did sorry, somebody was saying something.
Yeah, Sahil. So basically, there is a difference between enterprise value and value of assets, as you said rightly.
Correct.
Whether you should go for enterprise value as a RP or you should go for value of individual assets and then get it valued. So what do you suggest? It depends upon the company to company, or it's enterprise value which is advisable. So how do you want to go about it?
Can I take this?
Great question. Yeah, Vinit, please.
Yeah, so that's a great question. So enterprise value requires valuing or netting off the liabilities also against in order to arrive at an enterprise value, right? In the IRP or a CRP case where the claims are still being assessed by the RP while the valuation is being conducted by the valuer, we have generally seen valuation of assets as the most prevalent valuation that is being carried out. Sahil, you have anything on this?
Yeah, so the code specifically mentions the valuation of assets, and assets definition and interpretation of the code is clear. Whatever is appearing on the asset side of your balance sheet. So the general consensus and the mandatory requirement of the code is to carry out the valuation of the assets. However, there have been cases and scenarios wherein the COCs have seen or may foresee that there could be some enterprise value which will be very different from what the assets will depict, and hence what we have seen is that as part of the IBC process, as an additional scope, the COC is also at times asking valuers to carry out an enterprise valuation. Or we have also seen that before admission into IBC and taking a call, many banks prior to admission also would want to check the enterprise value. Just to name a few, say State Bank of India, which is again the largest bank, they on most of the cases check the enterprise value prior to admission into IBC, and only when they see that there is hardly any enterprise value left, and hence there is no reason or rationale to sell it as a going concern or outside IBC as a settlement, and hence they take a call that to take the company into IBC. That we have seen as pre-IBC also this enterprise valuation is carried out. However, sir, what we have seen is that I would also like to touch base upon few points, such as there are certain off-balance sheet items. Like for example, we will discuss a little more in detail. We will take it forward. So for example, sir, pre-qualifications. What we have seen is that infrastructure companies primarily have assets which are of little importance, but it is primarily the pre-qualification which gives you a window to actually qualify for these projects which are of great value. So in such cases, or for the fact real estate, say they have some TDR, there is a transfer of development right, or there are additional FSIs which are not appearing upon the books. So these are technically not enterprise valuations per se, but these are again part of off-balance sheet items which the COC specifically asked valuers to value in addition to the assets which are already listed on the balance sheet, so that they can get or they can negotiate better realizations at the time of getting a plan. I hope we were able to answer your question.
So Sahil, you want to say, sorry Sahil. So you want to say that in case of enterprise value, we do count not only on the physical assets of the company, but even intangible assets of the company also, like manpower, skill, the continuation of their basically for infrastructure company you require an entire set of technical staff, as well as, for example, if it is a port building company or some special kind of skill which is there in the staff and they have been doing it so since a long, so that skill is also to be measured, right? Like IT company, for example.
And let me add one more thing. Like for example, you have done Videocon, the
Right.
brand value of Videocon, or for that matter, any company whose brand value, that should also be included as a part of the asset, to my mind. And while you are saying that the asset are to be valued, then though it is not on the balance sheet, but it has a value and it is a great value. Like for example, mining rights in a cement company or in a steel company, that is also having a big value. So what do you do on those cases?
Thank you, sir. And I think so these were probably few of the things that we would have wanted to discuss a little later, but thank you for bringing them up, and great questions again. So just to answer one by one.
It's only a coincidence that this sir asking the question, his credentials are RP. Yeah.
So Rajji,
Right, sir.
just to answer, sir, one you mentioned, so there are 2-3 things, sir. One, there are certain companies, and just to take forward the example of Videocon, and so Videocon, for example, had recognized the brand as an intangible sitting in the books of accounts. So at least that made our life easier, as to it is already appearing on the books of accounts, and hence by virtue of sitting already in the balance sheet, we had done a valuation, or any other valuer would have done a valuation of that brand already sitting in the books of accounts. But to take this discussion forward, sir, we have also seen that there could be a company, say hypothetically a Ruchi Soya, right, which has so many different products, so many different brands, which is a large FMCG player altogether, and there are likes of so many other companies that we have seen which have gone into IBC. So not necessarily that all these companies have intangibles sitting on their books. In that case, sir, we have seen that specifically the resolution professional, keeping the COC into confidence, have specifically asked to additionally value these assets, even though which are not appearing upon the books, so that the correct and the clearer valuation may come out of the entire process. However, sir, the valuation report may be divided into 2 parts. One could be whatever is actually appearing upon the books, and second could be these off-balance sheet items, may it be a brand value, may it be a pre-qualification, may it be a TDR, so on and so forth, sir, according to the nature of industry to which this belongs.
Okay, Sahil, this is covering the difficult part of valuation, like valuing a telecom company or valuing mining company, or these are the difficult or typical problem of valuation. So if you have covered it in the later part, it's okay. Otherwise, you can cover it now.
Yes, so I think we are covering specifically mining rights also, and we will also be specifically covering pre-qualification. So I will probably ask Vinod to take it forward as we reach there. Vinod, should we do that, or you want to take it right now?
So I believe if the discussion is on right now, it is better let us take it right now.
Yeah, please go ahead. Mining rights as well as other intangibles we can cover, and EDR and all I can specifically take it forward.
So you can start with sorry.
One thing I want to ask.
Yeah.
One question I have. Can I come in?
Please.
Yes.
Yeah, Manish.
So basically, see in CIRP you have to compute fair value and the liquidation value. And if you look at regulation 35 of the CIRP, it talks about the valuation of the assets of the group of the assets, not the liabilities. Right. So fair value, does it if a company is a going concern, entity, did you ever calculated an enterprise value, or you calculated just the value of the assets and made an addition to it and give it at a total value? Have you ever calculated enterprise value in an IBC case?
So just to
we can touch base on one of the solar valuations or something on those.
Yeah, please go ahead.
You can go ahead.
Yeah, so again, Manish ji, what has happened is that, like Vinit was mentioning, so for example, a solar power plant, right? So there is a solar plant we valued in which it had a PPA for whatever reasons, under stress, went into insolvency. The value as per the assets or the asset valuation which we were discussing at this point of time is significantly different from what the cash flows would entail, and hence the enterprise value. So in that case, as per the code, it is mandated to provide a fair and a liquidation value in which a valuer will go ahead and assess the value of the fixed assets and the other financial assets as per the balance sheet. However, as I mentioned, to the wisdom of the COC, they took a call that to value as an enterprise also. So then in that case, additionally, what we did is we did an enterprise valuation looking into the cash flows past and obviously projecting it to the future, considering it's a going concern, EBITDA level positive operating unit. It made sense to carry out an enterprise valuation also, which would which in any which ways a resolution applicant or any investor would look at it from that perspective, and hence we had additionally given an enterprise value. But again, this request specifically had come from the resolution professional through the COC, and hence in such cases and certain cases we had additionally given an enterprise valuation addition to the fair and the liquidation value as mandated in the code, sir.
And who provided the cash flows in this?
So what happens, sir, we have seen both cases, one wherein the resolution professional has also given us the cash flows, and second, we have seen certain cases wherein we have taken some past trends and benchmarks and then forecasted it to the future and taken these assumptions. And again, those assumptions we had run it through with the resolution professional to make sure and ensure that we are not very off regarding any of the past performances, and we are able to correctly project the future cash flows of the company.
To also add here along with this, with respect to what Sahil just mentioned, when we projected the cash flows of a particular solar plant that we value, we not only we took help. So we have the infrastructure, we had the skill sets within our organization who understood the industry specifics in greater detail, and that helped us with the creation of the projections. Obviously, as Sahil mentioned, we ran through the entire projections with the RP, because unless that has been approved at the RP level, we cannot go ahead with the projections based on the cash flows that we have projected. Valuation based on the projections that we have done.
So you applied the income approach in that valuation, right?
Correct.
Yes, sir.
Okay. So did you apply market approach in any of the enterprise value method? Multiple approach?
As a check method, so you do valuations by market and income, and however, since an apple to apple or an apple to orange was available in a market approach, and hence we found it better or more appropriate to actually, in fact, sir, honestly, we have done both. There have been a case where we have valued it purely by income. There have been case where we have given due weightages to wherein we could get market comparables apple to apple or apple to orange. Then we have done valuation by both and given due weightages and rational and reason for apportioning it in the weightages that we have given.
And one thing, basically, what I have seen a lot of valuers report, especially land and building valuers. The typical line they use is on the basis of market survey. The market rate is 1 lakh to 2 lakh rupees per acre. So that's why we have taken 1.5 lakh per acre as an average price. And then if someone says no, it is 75,000 to 1.5, they say okay, yes, this can also be there. So they change it to 1 lakh per acre. So how much subjectivity do you hold in your report? Is there any professional judgment? Do you use any sale instance, actual sale instance, or is it just hearsay evidence?
Good that you brought up this point, sir. And I mean, it's unfortunate that you have had this experience wherein you have seen such discrete change in values. But sir, I can at least talk about us as a firm and what we do as a practice. And as you specifically mentioned, so our every report, and ideally, the valuation standards also mention and entail that whatever is your instances which you have relied upon, A, it could be either a sale instance, B, it could be an available for sale instance. या तो कोई property बेची है, या तो कोई property has been put up for sale, either of the two. So our report specifically covers and specifically also mentions, okay, there is this parcel of land, and not one, but at least in usual circumstances, our every report has 3 instances, because a valuer cannot base his valuation only on basis of one inquiry. It has to have at least 3 inquiries, and if there is some sense or direction or uniformity in the rates in those 3 inquiries, and however, I don't I agree to that point that the variation cannot be 100 to 150. 100 to 110, 100 to 115 can be a range, or 100 to 120 can be a range. But if we are getting inquiries in the range of 100 to 150, then probably we would want to do more inquiries till the time that we are getting more comfort and confidence whether it is 100 or it is 150. Then what we do is, after making those inquiries which are specifically mentioned, other details are mentioned and given, like for example, frontage, size, shape, leasehold rights, are there any tenants, is there any construction thereupon, is there any advantage or disadvantage, and those comparisons are done for each of these instances specific to our subject property, and those instances are accounted for, and those subjectivity has been removed by applying some percentages, giving due weightages, and all these calculations form part of our valuation reports, at least specifically. So we give Google map locations that, okay, here is our property, these are the 3 properties that we are talking about, this is the distance from these properties, these are the Google coordinates, these are the physical attributes, and these are the instances 100, 110, 120, and because of these rational reasons, size, etc., our valuation is, say, hypothetically 105. So this is how our report generally comes out. However, I do not disagree completely that there is subjectivity. However, subjectivity in that range of about 10, 15, 20% minus here and there is probably, I think, acceptable. But I don't think there can be a subjectivity of 75 to 150. That is too much of a range, which probably is an unacceptable range. And I completely agree with you on that point, that giving these points should be, is a specific part, and because ultimately decisions are being made based on the valuation report, so this should cover in the report, sir.
So basically, on the basis of market survey, only the value is right, is it?
Sir, that is, so market approach or sales comparison approach specifically entails market comparisons of transactions with the market. And see, today, sir, you or me want to buy or sell a house. What do? We go in the house and see कि ठीक है, कितने में बिक रहा है, कौन खरीद रहा है, कितने में बेच रहा है, कितने में खरीद रहा है. That is exactly what you and me will go and do. So similarly, whenever any transaction of any other assets also happen, that is exactly what any other buyer or any other seller will do. And hence, market approach for any of these properties is nothing but comparing it with the sale or available for sale transactions. And that is exactly what the valuation standards also mention, and that is what the valuer is expected to do also, sir.
And one last thing, just I want to ask: do you create any document for that? Any documentary evidence you keep?
Yeah. So as our process internally, sir. So there are certain places where, like say for example, there are some online inquiries, there are some broker inquiries, there are inquiries made available. So there is no, it is not mandatory as part of any reporting or documentation to be reported under IBBI standards, but we as a firm have these practice in general that whatever instances we are giving, we try and take backups to the extent possible. But we have seen that, say for example, there are 3 instances. There may be a case where all 3 might not be available, but we would at least want that at least 2 out of the 3 have proper backup, so that at least tomorrow when it is asked or requested for any further discussion, we at least have some independent backup basis and inquiry which can be discussed and challenged at any point of time in the later dates.
Sahil ji, actually under valuation standard there would be some compulsory record which you have to collect and maintain. So what kind of paper do you exactly maintain and collect for the purpose of your justification?
So sir, again, these attributes which I have mentioned to you, like say for example, first of all is our subject property, right? So taking into account the documentation of our subject property is a important part. Second is comparable instances. So whatever are the comparable instances and having clarity of attributes of those comparable instances. Say for example, if a valuer or a team from the valuer has not inspected those comparable instances, then he may not be in a position only to have a comparison being made with the subject property. So it's not like there is one property which is up for sale in Magic Bricks and that says 100, and there is one which is on any other portal which says 110, and then a valuer sitting anywhere in the country can probably say okay, this may be the value. Okay, this may apply to a specific asset class like say a flat or an office of a prominent location of a building, but for a land it is rare and far possible that such kind of an attribute be compared, and hence all these documentation in terms of findings of the valuer have to be part of the valuer's process. It is not a part of the mandatory reporting to IBBI. So there are certain specific points which IBBI has also clarified to the registered valuers which should form part of the valuation report, and in that there is no specific discussion of any backup document or base document being created, because ultimately it is to the skills of the valuer and the inquiries that a valuer has made upon its site and its findings, which are for his comfort again to be carried forward to the comfort of the COC and the resolution professional. Again, what we will also do is later in the presentation we will also run you through the various parts of a report which are already mandated by IBBI, and we will touch base upon that point also, which is again being covered in the later part of our presentation, sir.
Sahil ji, just out of curiosity, the say land, particular land, which is government value as per government ready reckoner, is say 100 rupees. But if you will go and sell it in the market, it may fetch around 70 rupees. So how do you value it?
So, sir, actually, very good that you brought up this question, sir, and this is being encountered by a lot of us. So, unfortunately, what happens is that guideline value or ready reckoner or jantri, as you may call it in various states across the country, may or may not, and more often it may not give a correct picture of what the value or the correct value is. So, as part of the process, we would rely upon independent sale transactions which would happen, because and not specific, because unfortunately what happens is that a guideline value is a general value only for the purpose of the collection of stamp duty, which does not, and there have been states, say for example, say Gujarat, last 6 years the guideline value has not been changed, right? And there have been states like Maharashtra where the guideline values have been increased and then reduced also. So that is a general, and let's say in Maharashtra what we see is that there can be a chawl, and next to the chawl there can be a skyscraper, and unfortunately the guideline value of the chawl and the skyscraper both is the same. So you are comparing an a peanut and a grape and an apple and an orange, everything all together, which is unfortunate, and hence relying upon this guideline value is probably not the right way to value. And hence, as discussed earlier also, to address to Munishji's point, as valuers relying on specific sale transactions or available for sale transactions is the right way forward, sir.
You come again with the last line?
Sir, so valuer should rely on the sale and available for sale transactions and not on the guideline value, sir. Guideline value is primarily only for the collection of stamp duty purpose of the revenue department, and that is about it.
तो अगर किसी प्रॉपर्टी का गाइडलाइन वैल्यू 100 रुपया है और उसका मार्केट वैल्यू 70 रुपया है तो हम 70 रुपया देने में कोई दिक्कत नहीं है, ऐसा?
Absolutely, sir. So 70 rupees ही उसका देना चाहिए, and there have been cases which have been like this, sir.
Thank you.
Vineet, would you like to take forward the off-balance sheet items, mining rights, pre-qualification?
Yeah, let us take it along with the
Sahil, one more question I want to ask you. When you are doing the fair valuation, right?
Right, sir.
I have one case which I am asking you so that my thing is clear. The land is agriculture land on which a plant has been set up or is under setup. The NA is not changed. Unfortunately, it has gone to CIRP. While valuing the land, the valuer has taken the circle rate, right? So I told him that this is not the right method to do it, because when you are doing the fair value, the cost of converting it into a industrial use, that should be changed from that should be reduced from that value. If my contention is right.
Absolutely, sir. So just to be clear, he has taken the circle rate considering agricultural or industrial?
Agricultural.
Okay, so I mean, one way to do it is that, sir, you take the fair value of agricultural, but not the circle rate of agricultural. Second way to do it is you actually take the industrial rate minus the cost of the conversion from agricultural to industrial.
That would be much better than, why I am asking you why I agreed with him was because this land cannot be used now for agriculture purpose because a lot of concrete has gone into the land. So
correct, sir.
To unearth that concrete, there is a cost, and to change the NA, there is a cost. So in either way, there is a cost. So why not you take the agricultural value and reduce the NA cost, and then it becomes a fair value.
No, sir,
agricultural value, you have to add the NA cost, no?
No, reduce the NA, because the guy who is buying it, he has to incur that cost now.
No, sir, he will either value it at industrial and reduce the cost of conversion from agricultural to industrial.
Right, right.
Or he will value it only as agricultural at this point of time. But sir, I think, and if I may, Rajji, the point here is actually multiple. And this we have also faced. One is what happens to the land, which I think we are just discussing, but also the second and the other greater problem is that if there is a chance that this conversion doesn't happen, and if there is a problem of conversion or whatever restriction on the conversion, then what happens to the fate of the assets which are already constructed on that land also? So sir, both these points need to be considered in tandem and will go hand in glove. And
that is precisely the reason I have taken the agricultural circle rate minus the NA rate, so as to come out with a fair value of that land.
Sir, similar case has been faced by me in one of the case. Hello. And it is not only the conversion cost that you have to take. In some cases, even like there is a period given for conversion from agriculture to NA in some of the states, and if you don't do that, then you cannot even you lose the rights of that land. Even in certain cases, it has happened. So means if in that case there is no value to that land.
No, in that state, in Gujarat state, it is not like this. It is a case of the Gujarat government. So I don't think that would be a case.
I am also talking about Gujarat only.
Oh, Gujarat only? Oh, okay.
Yes.
Sir, actually, there are a lot of projects. Just to add to what Manojji also mentioned, that there is a specific NA also provided. For example, only for a power plant, or only for a fertilizer plant, or only for a fishery, or only for a horticulture. And if and there is a performance clause that if it does not happen, so the permission is given for whatever benefit of employment and getting funds in that region. But if it doesn't happen, then there is a reversal clause also. ठीक है, अगर ये 3 साल में construct नहीं हुआ, तो your NA will be cancelled or null and void, or there may be the subsequent extension being provided. So just to add to what Manoj ji also mentioned, yes, those also I have been observed, and not just in Gujarat but other states also. There are specific NA permissions also granted, and due treatment have to be done to the specific NA permissions depending upon the comfort of those conversions happening or not happening, and the time that it will take, and the expenditure which may be incurred, and all these have to be factored into the valuation.
Sir, I have even seen the cases under Land Grabbing Act. In case agriculture is not converted into NA within the time frame that has been given, and Land Grabbing Act में वो केस हो जाता है, और फिर वो जो है there is a case कि भाई why you are not a farmer, how can you buy a agriculture land?
Correct, sir. Correct. Yes, so there are states which don't allow a non-agriculturalist to buy agricultural land, and there is only a time frame, a window of couple of years, if not a few months in some states, or specific, and it is mentioned that that conversion have to happen. Otherwise, as you mentioned, the transaction goes null and void. And the extreme case, as you mentioned, land grabbing may be problem ho jati hai, as per the Land Grabbing Act.
In fact,
And in the case of power plant, the building where the plant is installed, I'm not talking about the office building, I'm talking about the plant
Correct.
building. That is a part of
Yes, sir.
plant and machinery, or is a part of building, land and building?
Correct, sir. Great question, sir. So actually, technically, it is actually a fabricated structure per se.
Yes.
It may be allocated under building for the purpose of useful life determination and depreciation purposes. But even if we look at CERC tariffs or any other regulatory authority tariffs, so these are all buildings form part of fabricated structures, or these are primarily structures and not buildings per se, sir.
Okay, fine. That is my opinion also. So
Right.
I was having some dispute on this with the valuer. That is why I asked this question.
Correct, sir. So there are tariffs, sir. Central Electricity Regulatory Commission (CERC) also comes out with the assets and breakdown of those assets and benchmarks, in which they have given certain breakdowns of those assets, sir. Yes.
Okay. Thank you.
Vineet, we were at mining. Sorry.
What we can do is we can continue this during our presentation as we go along. In fact, there is one more question that has come in. In fact, I had while we were discussing on this land, I believe as valuer, it is also our responsibility, though I am not a land and building valuer, but it is our responsibility to have the legality of this particular case settled before the value is prescribed to a particular land, because as rightly being mentioned by the professionals in this meeting, that under Land Grabbing Act, the land itself the transaction itself could go null and void, and hence the asset on that land also, the value of those assets on the land would also be become negative in that case.
Correct. And just to add to Vineet, I would like to at this point of time share one example. So we did valuation of a composite textile unit. Now the issue there pertaining to land was that there were certain land parcels which were owned or which were in the name of the promoter, and there were certain land parcels which were in the name of the corporate debtor. And for whatever reasons, they were not able to convert the promoter owned parcels into NA and hence transfer it into the company. So as on the CIRP date, the situation stood that it is, if you go, it is one entire complex. However, intermittent plots are owned by the corporate debtor, and intermittent plots, non-contiguous plots, are owned by the promoter. Now, in this case, the problem and the greatest challenge was first to identify what assets are housed on what land parcels. and second, to get a comfort as to, say for example, we cannot value the textile unit as a textile unit if half of the building of the textile unit is on the promoter land and half of it is on the corporate debtor land, and hence the entire operations become disrupted because the land of the promoter is not being sold as part of the resolution process, and hence what the resolution applicant can get in a resolution scenario is only the assets which are housed on the land. So basically the charge of the entire land and the charge of the all of the assets and the land owned by the corporate debtor were given to the lenders, and hence the only way to value it in the way we did it was that we had to value it in such a scenario that tomorrow if you have to extract and on a piecemeal or a standalone basis what could be the value which could be ascribed to these assets which are housed on these intermittent land parcels of the corporate debtor, in addition to value the land which is of the corporate debtor and obviously the other assets. So again, this was again one of the cases which was very complicated in terms of identifying what land is whose and which assets are housed on what land and what could be their realizations as a whole. Does it make sense to value it as a unit or does it not make sense? And if we are able to value it in parts, then how do we value it? So this is again just sharing our example as to our experience valuing a textile unit having these complications.
Okay, Sahil, before you go ahead, there is a question in the chat box by Shrikant Dhawan, which says whether in a valuation report all values, that is fair value, liquidation value, as going concerns, lump sale, and individual assets, etc., are given. So Shrikantji, we actually only give we give value basis the mandate that has been provided to us. In most of the cases is fair value and liquidation value. Only if the mandate specifically mentions that we need to give slum sale value or enterprise value, we provide those kind of values separately.
And just to add to Vineet, what you mentioned is that in CIRP it is mandated to only give a fair and a liquidation value, just to make it clear. And in CLP scenario, these A to F are the various scenarios under which the mode of sale happens. So more often than not, what is happening is that the first order comes as a going concern. But what we have seen is that many times that the liquidation professional would want to get the valuation done under 2-3 scenarios at one point of time to avoid the repetitive valuations being done, or to also get a clarity on day zero as to how the values may pan out under different scenarios so that they can strategize and optimize best the mode of sale. So we, again, to add to Vineet, we have seen cases wherein we have specifically been asked to carry out under a specific scenario, or we have also seen cases in which we have been specifically asked to carry out valuation under 2 or 3 out of these 6 scenarios as mentioned under regulation 32 of CLP.
One thing I want to ask here is, is there any thumb rule for computation of liquidation value from the fair value?
Unfortunately not, sir, and I'll tell you why. And it will depend upon a lot of factors. A could be the type of assets, B could be location, C could be demand, D could be the nature of operations. So say for example, power plant or a cement plant or a fertilizer plant or a chemical plant or a pharmaceutical plant may have different marketabilities. An operating unit, a non-operating unit, a flat, a shop, a office, all have different demand and supply and marketability and operationality and operability, and hence there cannot be a thumb rule of which may be applicable to all under all scenarios. However, a valuer may take a different discount or a different percentage due to lack of marketing for asset class wise, or he may also taking composite or lump sum across the company. So this is what we've seen across various scenarios. Again, this is left to the independent judgment of the valuer, but one size fits all, maybe not in our opinion, sir.
Because what I have seen is there is one case in the CIRP. So there is a plant over there. It's basically a rice mill, So you have a land measuring around 1500 square meter, and then you have a building over it, and some plant and machinery was also there. The plant was not running. So the RP engaged land and building and plant and machinery valuer. So plant and machinery valuer did his job. He counted whatever is there, listing and all. So he valued it on DRC basis and all. So now when land and valuer come, so he valued the land on a market approach and building on a DRC method.
Right.
And then he calculated the fair value. And then he provided a 15% or 20% discount. I don't exactly remember. And then he said this is a liquidation value. And then he said this is a liquidation value. So I asked him what is the logic behind this 15 or 20% discount you applied. So he said this is as per the market trend we apply. There is no as such documented theory to it. So is it somewhere an acceptable practice in the market?
Sir, basically it is acceptable practice to discount the fair value to arrive at a liquidation value, and I will share the rationale behind it. Is that today you and me go and buy a property from a bank, say for simplistic purpose it's a house. We know that the value of the house is 100, but today we know that there is stress and we may take advantage of the current scenario as an investor, and due to the discount, due to the lack of marketability of that property today, and looking into the current demand and supply of that subject property, we may opt to bid 70, 80, 85, 90, 95, however, depending upon that specific property. So discount from that 100 may be 5, 10, 15, 20, 30, depending upon the specific nature of that asset, the marketability of that asset. I think it is the right way to value it to arrive at its liquidation value. And yes, that is a norm and a general, but I cannot control as to is 20 correct or is 15 incorrect.
Okay, and one more thing, does the cost of brokerage and other transfer expenses also also deducted while calculating the value?
Yeah, so sir, in the liquidation scenario, sir, ultimately it is a realization which happens, right? So in that, all the costs to sale are discounted. So may it be, it's the way you look at it. Say it's a real estate property. Either you hold it for 2 years and you discount it and look at its value after 2 years and value its NPV today, and you factor in the various other costs like brokerage and costs to hold that property for those months or years, and those are discounted, and hence whatever is that discount rate is marketed is already apportioned into the fair value basis, which you apply a discount and arrive at liquidation value.
So you deduct it, right? I didn't get it.
Yes, it is deducted.
It is deducted in liquidation value, not in the fair value, is it?
Not in the fair value level, sir. Yes, because at a fair value, unfortunately or fortunately, the code does not entail a third party, because the resolution professional carries out the sale process of the assets or the company of the corporate debtor. So in that case, there is no third party who is actually an intermediary who actually markets and sells that assets.
So stamp duty is not liable, right?
Stamp duty also doesn't fall, or any other, for that fact, any other taxation or duties or any other tax implications are not forming part. All those are separate, sir. Additional.
So just last thing, can we say that 15-20% discount what has been applied include the cost of sales also, right? Is it?
Yes, it's exactly the cost of sales, sir. It does.
Thank you.
Yeah, so coming back to C, set of assets collectively. So just to give you an example, we did a valuation of a shipyard, and the shipyard was attempted to sell as an entire shipyard as a going concern. And when that attempt did not go fruitful, the next attempt, the liquidator bundled up the assets in such a way, like say for example, the inventory made with the steel and the other assets which can be salvaged, along with the plant and machinery and along with the under construction vessels, they were all bundled up together. The land was, along with the building, was bundled separately, and then these collective assets were sold or put up for sale. So in this kind of a scenario, what it does is that somebody who's interested only for the land might come and bid only for the land and need not go and bid for the other assets for he is not interested. Similarly, a person who is interested only for the metal or the salvage or the vessels or the other assets might look at it only from that perspective, and hence it is a win-win wherein a higher realization might happen because somebody is not taking a bouquet of entire flowers. He is able to pick and choose which flower he wants to pick up or what bundle he wants to do. So see, a set of assets collectively is basically when an asset class or a group of assets are bundled together and sold for a higher realization. Similarly, the case in D is specifically land when it speaks about parcels, wherein land and various parcels of lands are bundled together and sold together for optimum marketability. E we already discussed is the corporate debtor as a going concern. F I would like to discuss a little more in detail and give an example for the same. So for example, we did a diversified unit, one which was under they had some fabrication shop and engineering unit. Second, they had a textile unit, and these were the two major business of operations. There were major issues and problems pertaining to labor, etc., in the textile unit, which ultimately brought down the entire corporate debtor as a whole. So then, in that case, but however, the engineering unit was EBITDA positive, was a good unit, and was performing well. However, as a group, because of having the diversified nature and the textile unit taking up a lot of capex and not being able to see the light of the day due to these issues, sank the entire company. So in this kind of scenario, selling the business of a corporate debtor and business separate of say a manufacturing engineering unit here and textile unit here, in this case might have a higher realization because somebody might not need to buy both together and can look at individual marketability and sellability, and hence in F scenario it will be a business of corporate debtor as a going concern and not the entire corporate debtor having diversified businesses as a going concern. We may just move ahead, please, Vineet. Okay, PIRP, just spent 2 minutes on this since we understand already that there have been a session and we've already in detail discussed. But from valuation standpoint,
would like to question one thing. That is that
please,
what is the role of RP in the valuation? Means should he interfere into the only discussion level, or it should be like a detailed role? Because my understanding is in this, then when we appoint a professional to do the valuation, I should not interfere much on that. So what is the role of RP with this valuation work?
Right, great question, Manoj, and this is what we have also seen in our experience, and good that you brought it up also. So, sir, there is one. I mean, as you mentioned, once a professional is appointed, so there should be no interference per se from the resolution professional. However, sir, there are like a resolution professional is new to that corporate debtor. Same is the case for a valuer, and a valuer looks up to the RP and RP team for a lot of data. So the more the information, the clarity the valuer gets, the better position he is in to give a report basis which the COC is able to take a decision thereupon. So the idea is to have a cohesive effort, and by mean cohesive, again I agree with your point, not to interfere or influence upon in any which way on the value part, but cohesiveness for sure, to give adequate comfort and clarity upon the data, because the more the data, the information, the clarity the valuer gets, the better position he is in to ascribe a value and give more clarity and detailed report thereupon, sir. That is the intent.
Sahil, I am also facing the same problem. Actually, it is a reverse situation. Like if I have given work to valuer, before that I got basically the promoter wanted to sell that particular property. Now that property was he got that from a very reputed builder of a particular amount, say 90 rupees. Okay. Now in 90 rupees, that reputed builder wanted to purchase that thing. Now, if I give the same thing, same land for valuation, now he's coming out with say 300 rupees or 400 rupees as the value. The problem is that the base which he is taking is the plot, which has been sold prior to 5 years nearby the station, whereas this land is located not nearby the station, but it is located very far from the station, say 5 kilometers from the station. But the rate which is taken by him, ready reckoner rate, is the base which has been taken by him for selling that, valuing that particular property, is that particular rate at which the last land was been sold. And this, the land based on which he is taking the valuation, it was just say 1,000 square meter or 2,000 square meter plot of land, whereas mine is in acres. So so there is a big problem with tussle between me and valuer by stating that भाई अगर मेरे को बेचने का है तो 300 रुपये में तुम मेरे को लाके दो, कोई भी चलो 200 रुपये में लाके दो. If you say कि भाई अगर इसका 300 रुपया वैल्यू है, मैं I am ready to sell it at 200 rupees, but you unnecessary, if you will hype up the value, I will not be in a position to justify to my COC members, as well I will not be in a position to sell it out at that value. तो अभी भी वो सब मतलब this kind of situation, what we should do, you tell me.
So, sir, it's unfortunate that you had to go through this, but independently, if you ask our opinion, one, it has to be an apple to apple or at least an apple to orange comparison. Second, it has to be, if it is as dated as, I mean, ideally it should not be 5-year-old transaction at all. But if suppose it is couple of months prior, then those adjustments have to be duly made. Also, in terms of size, as you mentioned, say our plot is say hypothetically 25 acres, and this is probably a couple of thousand meters. So then that's not an apple to apple. So those attributes and those comparisons need to be factored into the valuation, and hence after factoring all these things, the valuer should come out with the report. At the same time, sir, I would also go ahead and say that if there is already a precedence and hypothetically it's already available, say 90 rupees in the public domain, a valuer may also not get influenced by that 90 rupees and give his independent opinion basis the market transactions and doing these adjustments towards these attributes, may it be size, may it be location, may it be the time of sale, and hence then come out with a value, sir.
Because then it will be very impractical for me to sell that land. और COC बोलेगा यार 300 रुपया valuation है, तुम बोलता है कि 100 रुपया भी नहीं आएगा. So how it is possible? So that is the problem is.
Correct, sir. I mean,
but sir, can you influence the valuer? That is the question.
Change the valuer. Change the valuer.
No, change the valuer means you have the option of law is saying that you have to appoint two valuers. So if one valuer is doing this, the other valuer must be giving the right valuation, and then you can appoint the third one and then take the average of the two nearest. So there lies the solution, but you cannot change the valuer just because he is giving a particular value.
Right. That is precisely, I cannot change him, and I already registered his name with the IBB and every website that.
Correct, sir. So, I mean, again, as we mentioned, sorry, go ahead.
You can go ahead, sir.
Yeah, again, sir, we were discussing upon cohesive efforts. I mean, so as much as the value maximization is the intent, but the idea is that the value should be realistic also. And if there is any assumption which has been taken by the valuer, or if there is any other assumptions which, see, RP is better equipped to know the situation and scenario and past and present of the corporate debtor, and hence
sir,
taking
my say on this is that we can give our ideas to the RP, to the valuer, that as per me these are the pros and these are the cons of this particular property. Sir, apart thereafter the final decision is by the RP.
5 meetings has been arranged personally, explaining the problem in the area. There are so many litigations going on in the some various courts, everything. But he say no. अभी तो इतना ही चल रहा है और इतना में तो होना ही चाहिए करके. you know, और उसका क्या है कि both of them belong to the same, I think, organization of valuer. So both of them are, you know, coming with each other. So, you know, basically that is the problem. So one is getting influenced by other. So that is the main problem issue.
So ask him
Generally
to sell the land for you and give him commission for that.
Okay, I think
Sir,
let us go ahead. I think.
yeah. So just 2 minutes to touch base on PIRP. Primary difference is creditor in control versus debtor in control in PIRP. Again, for MSMEs it is applicable. Since the corporate debtor is in control and is interested party, he will cooperate more in terms of the data, the details, the documentation, site visits, inspections, plans, documentation, so on and so forth. And hence it is slightly better since he himself has to come up with a proposal and come up with a plan himself, and then that under Swiss challenge will be challenged by any other resolution applicant. So one major difference which happens is that the it is anticipated and hoped, while it will happen only when we live through it, we will be in a better position to comment, but it is hoped at least that these problems should be negated. However, PIRP being a quicker process, the valuer appointment happens in 3 days as opposed to 7 days in CIRP. The valuer gets time till the submission of resolution plan in CIRP, which may happen in 2, 3, 4 months of time for the valuer to carry out a valuation of the corporate debtor assets. However, PIRP being a quicker process, he gets about 30-32 days since the resolution applicant, since the plan needs to be put forth in T plus 36 under PIRP, and hence a shorter duration is entailed in PIRP. These are primarily the valuation related differences which are governing PIRP and CIRP. However, we shall be happy to kind of live through PIRP and then have a session specifically upon it sometime later. We can go ahead on this for now. Vineet, next please. I think we can just skip this typical valuation process. We'll go to some specifics and discuss some cases in specifics. Vineet, next please. Selection and appointment of valuer is the first step, which happens signing of non-disclosure, engagement letter, non-conflict. Again, what we have seen as a part of our experience is that there may be still a L1 based concept in many scenario and cases. However, we have also seen that in a lot of cases, COCs have taken call, the RPs have taken call and given due weightages to the technical expertise and experience and relevant sectoral experience of a valuer, and due weightages have been given. So A, only those valuers are shortlisted and called for in the RFQ, and B, if at all they have called from others, we have also seen in our experience that due weightages have been given and appointment of valuer happens taking cognizance of all these factors. But again, it is ultimately to the wisdom of the COC and the RP to take a call upon the appointment of the valuer. Next, please. Okay, so what we would want to do is that we would want to run through the entire process of what documentation a valuer asks as part of the valuation process, what could be its rationale, and how a valuer looks at that data and how does he value it. This is what we would want to run through in this typical IRL, which is an information requisition list, which any valuer would ideally send out. This is a test sample IRL which we send out in our IBC mandates, and which we've kind of projected it here for the ease and reference and discussion of all. Here in general category, first and foremost, the most important point is the audited balance sheet as on the insolvency commencement date. So typically what we have seen is that RP comes in, he takes some time. Many a times we've seen that even till the submission of the resolution, even till the submission of the valuation report, the audited balance sheet is not made available. Many a times even the unaudited balance sheet is not made available. It is an unsigned Excel also, which comes many a times. At times we have seen that audited balance sheets are made available, but which is rare. So first and foremost is that the base document on which a valuer relies is the insolvency commencement date balance sheet. And since these dates are not in tandem obviously with the financial year and reporting dates or any quarterly results or any quarterly ending dates, and hence RP also finds it difficult, and however, to the best of their abilities, they give whatever is the latest or last available information. But again, since that is the base document which forms the part of the valuation, it is best suitable to send out the ICD date balance sheet at the earliest possible. Next, please.
Sahil, no, Sahil, here I have a couple of points. As a process, what we do. So, for example, if we are made available an unaudited or a management approved financial statement, as a valuer, we carry out our analysis on the financial statements that have been provided to us. We compare those financial statements with the immediately past audited financial statement in order to understand if the financial statement in the provisional state that has been provided to us is not markedly different from the last audited financial statements, so that we are aware on the what kind of figures we will start working on, because as professionals you will understand if the base with which we start itself is incorrect, the entire exercise will go for a toss at the end. So as a process, we compare the unaudited or provisional financial statements with the immediately past audited financial statement, and if there are any major differences that come out of it, we enter into discussions with the RP beforehand. Also, what we have observed is so the insolvency resolution date could be somewhere in the middle of the month, say 13th of June. For an RP to be able to get us the balance sheet for the insolvency resolution date sometimes becomes difficult. Sometimes we've seen entities are running ERP where the closures are the ERPs can't be closed on a particular date. Generally, ERPs closures will happen end of the month. So in such scenario, the provisional financial statements or the financial statements that are provided to us are closest to the date of the insolvency resolution date, which would be, say, in case of, say, it's a 13th June, we could get a 30th June or maybe 31st May. And we have to carry out our own understanding or analysis of if whatever the difference, major difference, if there could be between these 13 days from the financial statement date to the insolvency commencement date. Sorry.
Vinit, if you can just move to the next slide, please.
Yeah.
So again, once the ICD insolvency commencement date balance sheet is made available, first and foremost, what we do as a valuer as pertaining to the fixed assets is that we tally that the fixed asset register value is tallying with the total gross and net book values appearing upon the balance sheet. Now, many times what happens is that there can be two scenarios. One is that a FAR is not made available. So then in that case, the RP says that we have a list available for whatever reasons, may it be a smaller account, company doesn't have hello, am I audible? I'm getting some network intimations. Am I audible?
Yes, you are.
Okay. Sorry, I was just, it was a pop-up saying that the network is poor.
Yeah, so you can switch off your video. That will just help.
Yeah, so far so good. If it does, again, probably I'll do that.
Yeah.
So one is that if a FAR is not made available, so then what happens is that, say hypothetically 100 rupees of gross block and say hypothetically say 50 rupees of net block is already appearing upon the books, and then if a value, say a valuer assesses a value of say 20 rupees of fair value and say 15 rupees hypothetically of liquidation value. So now projecting that as 20 rupees is a fair value as opposed to 50 rupees of net book value and 15 rupees of liquidation as opposed to 100 rupees of gross book value as a depiction is an incorrect depiction. So what happens first and foremost is that a valuer needs to understand that whatever 100 rupees of assets, those need to first be taken into account. Second, we have seen is that if there is no there is an FAR available which has 100 rupees of assets is available, but during the physical inspection, site inspection, 60 rupees worth of assets are available, balance 40 are missing. So then in that case, we have also seen that, you know, promoters have siphoned off those 40 rupees of assets, there have been pilferages, there have been shifting. Intentionally, the better assets have not been showed by the corporate debtor during the verification, so that those don't form part of the list, so on and so forth. Again, that is where what we talk about the cohesive efforts of the valuer and the resolution professional is that in our experience and what we have done as a practice is that any such findings we immediately flag off to the resolution professional, and if there is the resolution to COC or to NCLT, then he may flag as part of any, may it be an avoidance transaction or any other mischief paid by the promoters. So what happens primarily is that this fixed asset register value and the balance sheet as on ICD value should first step of the entire valuation exercise.
I have a question.
Yes, please.
The question, during this valuation of fixed asset, the physical verification of fixed asset is whose responsibility? RS responsibility, or it will be responsibility of registered valuer?
Yes, thank you, Sashiji. So the code explicitly mentions that the valuer shall issue the valuation report after physical verification of fixed assets and inventories. This is what verbatim the code mentions. So it is the responsibility of the valuer to inspect and physically verify. However, he relies on the corporate debtor and RP to facilitate that inspection. What assets are lying where, कौन सा asset कहाँ पे है सर, वो किसी ना किसी को बताना पड़ेगा.
Yes.
And hence only after somebody guides. So for example, there can be, we have seen infrastructure cases, companies where projects are happening across the country. So it is very difficult, and many times sir, assets are in transit. On day 0 they will tell you that today it is in Gujarat, and day 1 it will be in Maharashtra, and day 20 it will be in Rajasthan. So, and at times sir, these are only mischiefs created by the corporate debtor only not to facilitate the inspections. So to answer your question, the verification has to be carried out. It is the responsibility of the valuer. However, this has to be facilitated by the resolution professional by the help of the corporate debtor, sir.
Thank you, sir. Thank you.
I think there's a message by Mr. Sanjay to circulate. Yes, sir. What we'll do is we'll share. We have already done that. We've shared with Hemanji. Hemanji requested to kindly share this presentation with everyone for the interest and benefit of all.
Thank you. Yeah. Okay.
Second, cost bifurcation into basic assets, taxes, preliminary pre-operative expenses. Just to throw some light, so we did one evaluation in which the capitalized amount, hypothetically, instead of being 100, we found it to be almost 400 rupees. So we tried to investigate and try and ask that why does it look and appear to be so much on the higher side, and hence it was told that the plant was under trial run for some 5-6 years, and hence all the interest and the preliminary pre-operative expenses to bring it from trial run to commercial production, along with all interest during construction, so on and so forth, were capitalized, and hence the 100 rupees got bloated up to the extent of almost 400 rupees. So ideally, a valuer, once he is privy to these facts, then only he will be better equipped to, I mean, first and foremost, looking at it, a valuer could also judge and should also judge that there is some mismatch. Hence, once he is privy to this mismatch and getting this cost bifurcation into what is the basic cost, the preliminary pre-operative expenses, duties, taxes, so on and so forth, actually look at what is the specific equipment cost and what are these other soft costs which are loaded onto the total value, so that then he can appropriately value and apportion value to those various hard and soft costs. Immovable properties, land with area statement location. I would like to share one experience here. So again, fixed asset register only mentions the listing of land. However, it is extremely important. I would like to also cover points like map and total summary, so on and so forth, as mentioned over here as part of it. So we did one valuation in which our value and the other valuer's value pertaining to one very large land parcel, which was a large contributor to the overall value, was significantly or was probably 3x different. So it was brought to the notice of the resolution professional, and again, as Hemanji mentioned, he tried to discuss with the valuer. The resolution professional came and told us that there is a stark difference, and upon the discussion, we gave him details like basic things. He asked us, "Kaun si property dekha, kaise identify kiya?" And so what we did is we shared photographs. There was a corporate debtors authorized representative who facilitated our inspection. Same was the case which we were learned happened with the other valuer also. Interestingly, what had happened is that the land parcel which was shown to us and the land parcel which was shown to the other valuer by the corporate debtors representative were two very different land parcels. Unfortunately, what happened? They did not have a plan. Since they did not have a plan and it was open parcel of land without any demarcation, एक को बोला कि ये वो this is that land, दूसरे को बोला this is that land, and they gave some hand sketch kind of a drawing, and both were given different. Since one was very different from the other, it had a very significantly different impact on the value. Even more so surprising, when this reconciliation happened and it was brought to the notice of the resolution professional and then to the corporate debtor, ultimately we were shown a third parcel of land, for which we were ultimately given the plan also, which was the actual plan, which was the actual land owned by the corporate debtor. That this is the actual land. The one valuer was shown something else, the other land valuer was shown something else, and the actual was something else. So all this reconciliation happened, and there was whatever reasons of mischief are done by the corporate debtor, and different land parcels were only made available for inspection. And again, only upon this reconciliation it came to know, and ultimately there was a joint inspection by both valuers in presence of RP, and an inspection was carried out to finally identify the land and carry out a valuation. So again, whenever the idea and essence of asking for revenue survey maps and total summary area statements, NA order, sale deed is this to properly identify the land.
Yeah, Sahilji, even when we visit that particular piece of land, we normally the valuer also try to take the Google map exactly where he is standing, So
Correct.
that also it is helpful for them to locate the exact land location.
Correct, sir. Great point, sir. So just to add, unfortunately, what happens is that, sir, Google gives latitude, longitude. Now that latitude, longitude specific is probably covering about 50 to 200 kilometers radius area, sir. So unfortunately, the latitude, longitude of both the valuers were, in our case, was coming the same.
Oh.
So that as a practice, even we do that we give the specific latitude, longitude as well as the Google imagery of the value of the property. But since it was, so problem here in this specific case was again that there were promoter land and there were corporate debtor owned land. So what they had shown to us, which we later were told, is that it was part of promoter land, but everything for the corporate debtor representative was owned by the company only. So hence, एक को कुछ दिखाया, दूसरे को कुछ दिखाया, and ultimately it was what was originally owned and actually owned by the corporate debtor was a third thing altogether. This was the case in this specific case. I see a question by BS Rathi asking, have you seen any negative values? Yes, any deletion of assets, whenever it happens, we have seen that there have been negative values. Ideal scenario is that, say for example, I bought one asset, say 100 rupees. Against that asset only I will reduce, say, part of that asset if I have sold, or if the entire asset I have sold, I have a negative entry, and hence it is written off directly, and hence there is no negative entry per se appearing in my books and no confusion whatsoever. But many a times what happens is that, say for example, there is a chemical plant which has a reactor and which has a pump. Now that pump regularly needs to be changed every, say, 3 years to 5 years, depending upon the kind of hazardous waste that it is managing. So what happens is that typical capitalizations look in such a way that total asset value is 100, and you can see a -20 somewhere, or you can see a -10 somewhere, and you can see a 15 somewhere, and it is not identified or allocated specifically to which asset it is reduced from. And hence there, yes, there have been cases that we have seen negative values as well. Coming back to the immovable assets and the documentation, again, other documents like 712 extract of land. So I will share one experience over here. There was one land. So basically 712, so sale deed happens at the time of sale. Say for example, corporate debtor bought that land in say 2010, and they have a sale deed, and even if they have sold it to somebody else, hypothetically, they still have that original sale deed in which they have that copy of that sale deed in which they have bought that land in 2010. Now what happened is that we did a valuation of a company, and upon local inquiries we sensed some issues, and there were some sense that this land doesn't even belong to the company and it has been sold off. So fortunately that there are some states which give you latest 712 extracts. Gujarat, Andhra Pradesh, Telangana are some of the states where you get 712 extracts online. So what we did is we checked the 712 extract, which is a current date ownership document, which tells you what is the current ownership, are there any liens or any other mortgages or any other encumbrances on those lands, what is the extent of the area, and who is the specific owner. All these are available in the 712 extract. Upon our surprise, and honestly we were not very surprised since we got that input, is that we came to know that this land has been sold to somebody else. So what we did subsequently is that we brought this to the notice of the resolution professional, and then it was escalated to the COC, and then ultimately that money, whatever proceeds were, since the balance sheet was not filed by the company for last couple of years, the corporator gave an explanation that this was sold and subsequently not appearing, may have not been appearing, but since an old balance sheet has been taken cognizance, and hence this is still appearing on the books of accounts, but this has been sold. But it was not to the knowledge, there was no NOC taken from any lender whatsoever, and whatever realization that happened, the corporator was intimated to bring them back and return it to the company. So this is again 712 extract primarily for land parcels and its importance. Building plans again give you the extent and expanse of the buildings with details, year of constructions. So I'll just share an example. So at times, you get a insolvency date, commencement date, balance sheet. You also get a FAR matching to the rupee, but it is visible and clearly visible that the entries are cooked up. So I'll just share an example wherein we were given, this was one large steel plant, total debt of about 10,000 crores odd, which we valued under IBC. So it had information like land was purchased hypothetically in the year 2000, plant and machinery was started to purchase in the year 2010, and building was constructed in the year 2015. Now logically these events don't make sense. That how can you purchase a plant and not operate it for 15 years, and house a building later and purchase the plant earlier, and it didn't make sense. And there was an instance in which the reverse order was also there, that the building was constructed first, plant machinery was taken next, and the land was purchased third. So again, the idea of getting proper documentation is to cross check and validate and revalidate, in which any loopholes are there in the data which are maybe fabricated for whatever vested interests, so that again, I mean, this is also to the experience and expertise of a valuer to sense that there is some issue, and since he has a kind of understanding and expertise, will be able to sense it out. But again, these documentation would make sure and ensure that any of these happening, any of the cases can be spotted out easily. Approved plan FSI statements again are very specific to real estate, which we are all aware of. Next, please.
A question is there for the date of capitalization. What you are raising, there is a inconsistency regarding the date of capitalization. Actually, we chartered accountants capitalize on the asset on the basis of ready to use. Many instances where there is a construction of plant and machinery, building, date may be here and there, because sometimes as a auditor or as a management side, if I am sitting as a CFO, I have to take decision that okay, this was not ready to operation, but some operation was commenced. So this might be a reason for inconsistency. But from the valuation perspective, are you going to revisit those dates which have been taken and or taken as a audited date?
Great, Shashiji. I will just answer. So we understand that as per capitalization and valuation accounting standards, there will be a gestation period. You might buy a machinery or a building on day zero. Say a steel plant or a power plant might take 1 or 2 or 3 years, depending upon the size, to ultimately come to the commercial production. Ultimately, when it is be capitalized. So those tenures of depending upon the gestation period of an industry are acceptable, sir. However, there have been cases wherein we have seen inordinate things, like for example, there was a power plant which got delayed by 9 years, and it is freshly and recently capitalized, but it has already outlived 9 years of its life, because there were some assets lying at the port, there were some issues, customs related, then came in further issues, then trial run happened, did not happen, and ultimately it saw the light of commercial operations only after a long period of 9 years. So in that case, sir, if you ask me today, that valuer has two choices: one, to take a life from the date of capitalization, but in my opinion it would be incorrect, because ultimately there have been assets which have been dilapidated or have been put to use or have been put under construction for a period of 9 years, and which has already outlived that period, and hence the that asset is balance economic life per se of already deteriorated to that extent. So my only point here and specific point here to address to your point is that whatever general gestation period is acceptable. However, anything abnormally high has to be accounted for in the valuations.
Okay, thank you, sir.
Sure. Again, plant and machinery, I think we've already discussed. We will move to the next. Vineet, you can take it forward for the intangible, I think, which we've been waiting for since. Yeah, Vineet. You are on mute, Vineet.
I'm so sorry. So with respect to the fixed asset, one of the asset category that we value is the intangible assets. We've divided intangibles into two. Intangibles in form of softwares. One of the basic questions we have always been asked, whether will you value software. We have sometimes seen a lot of investments goes into ERP software of a company, and when we value the company under going concern, it is only prudent to put a value to such ERP softwares which have been invested upon it by the company. However, the immediate point of contention would be, in case of liquidation scenario, how would you value a license cost of a software? Again, if we are valuing the company and as under going concern scenario, in the liquidation value, we will carry the value of the software. But if we are valuing it on the piecemeal basis, the value of the software will have to be put as nil. Next item would be where most of the interest lies, is other intangibles. So in other intangibles, we have seen brands being capitalized either on the asset side of the company. In such a scenario, so for in an instance case, there was a participant who raised point on the brand of a Videocon company being Videocon company being valued. So as rightly being pointed out, a brand like a Videocon or any other such brands which are acceptable brands in the normal parlance should be valued in order to arrive at a value in order to arrive at a value under going concern, a fair value, as well as a liquidation value under going concern scenario. Now, what kind of valuation approaches do we follow with respect to the brand valuation? Again, there are three approaches that we could follow. There could be a cost approach. So in cost approach, there could be a scenario where a brand would have been acquired by a company in the past, and such cost is appearing on the balance sheet. We could look at such cost that has been paid by the company in order to acquire a brand as a basis of our value. We could also look at market approach, where we would compare a similar brand. Say, for example, in case of Videocon, a similar brand, apple to apple brand, being for the purpose of evaluation of a brand. And also in case of income approach, we could use a relief from royalty method, or a premium that a brand could fetch. So for example, a coffee at a regular thela could cost you around 20 rupees, whereas a coffee at a cafe coffee day or a Starbucks would cost you around 150 and 180 rupees. It would be slightly different in terms of taste and the attributes and in terms of the quantity. However, the brand itself fetches an X amount of premium over other coffee brands. So maybe we could compare a Starbucks to a cafe coffee day in order to arrive at make it more comparable. So a brand that could fetch a higher premium would obviously fetch a higher brand value for the purpose of the valuation of such company. In case of intangibles, what we have also seen is there are certain intangibles which do not form part of the asset of the company. However, they carry a lot of value to a corporate debtor. One such case was raised by Sahil, where we said a pre-qualification. So in case of an infrastructure company, pre-qualifications are, in my opinion and in our opinion, an entry barrier. X company being able to bid for road of a size and of a value above a particular value, or being able to bid for airport projects, or being able to bid for a port projects, depends on such pre-qualification experiences that the company has gathered over past years, which obviously creates an entry barrier and hence has a value. So if a resolution applicant is interested in an infrastructure company, he would definitely be also interested in valuing a pre-qualification that would help him bid for such projects going forward, and hence pre-qualification has value. Now, pre-qualifications do have a value. How do you value such pre-qualification? In which case, which was the challenge that we faced. So in one such instance where we were valuing a company, the company had pre-qualification in X number of sectors. For example, pre-qualification in port sector, pre-qualification in airport sector, pre-qualification in a road sector. What we did is we tried to study the past trends of tendering. We tried to study how many bids does such company put, what is the actual success rate of such bids, and what has been the actual success rate of such bids in the past, what is the market potential going forward. So for example, if in the road sector the government has announced projects worth say 100,000 lakhs over a period of next 5 years, we would, based on the past historical trends of the company, we would extrapolate and bring such analysis to the future business potential, obviously putting in some sort of what do you call, discounting in place in order to understand, in order to bring some reality to the fact that the corporate debtor is under stress and might not have the similar success rates that it would have fetched in the past. So such kind of analysis and discounting rates, we would arrive at potential business opportunity that a resolution applicant could have, if, or potential business opportunity that the corporate debtor could have going forward. Basis such potential business opportunity or basis such potential success rates, we would put value to a particular pre-qual. So this was a process that we put in place. Now, so this particular process itself could be very subjective in nature, because it is absolutely dependent on the valuer's understanding of a particular industry, valuer's understanding and analysis of the data that has been provided by the valuer, and hence it is very critical that the valuer puts in place right skill sets in order to arrive at value that is sustainable and that could be explained to a relevant reader of the valuation report.
Sir, I have a question. Sorry to disturb you, Vinit ji. See, there are two. Basically, we are just now talking about the intangibles which are not recorded in the books, and we are discussing about that. And you have rightly discussed one or two examples that where the intangible is not recorded in the books and there is an intangible. But lots of time we might not find that intangible has been recorded in the balance sheet because of the accounting standards requirement, because the internal generated goodwill, internal generated brand, and even the customer relationship, distributionship, these are not recorded. But the challenge is there when you are as a valuer. Suppose I am going there and I am seeing that these might be have a intangible or in the books, but this has not been recorded. But how can I go about to have a checklist? Okay, I will not value customer relationship. I will not value distributionship. I will not value this brand goodwill kind of things, which is not being recorded. Because this insolvency case, there is a going concern, but there is something strain on the cash flow, future cash flow. That's why it is not there. But you know that internally it is there. If the management, good management is there, the management is putting money or resolution applicant is putting money, this will help you to generate the cash flow. But how you will overcome these challenges, which I have mentioned, which is not recorded, and no resolution professional will give you. These are you should value this.
So thank you, sir. That is a great question. But what our experience says is, in case of a brand valuation or a pre-qual valuation, COC as well as RP themselves are also interested in understanding if that they will be able to fetch, and if there is a value to it. What challenges we have faced is to bring on table the data that is required to put our analysis in place in order to arrive at a value to a pre-qual or to a brand which has not been accounted for. As has been spoken in the past, value maximization is the single most objective, not single most, is the objective of the IBC, and hence RP would also understand that there would be an instance where RP would not be able to recover the brand value in case of a fair value scenario or in case of a liquidation scenario. However, in order to understand what value does brand have and what value does pre-qual have, COC members as well as the RP does expect us to carry out that kind of valuation and put it on in our report. This has been our experience.
Okay. So have you valued any kind of intangible which is not recorded in the books officially?
So as I just mentioned, sir, pre-qualifications are never recorded in the books. What is pre-qualification? So let me come back at that. So in case of a road infrastructure company, for a company to be able to bid a road project, say of a value in excess of 1,000 crores, there are various pre-qualifications that the tender mentions. That the company should have X amount of capital, that the company should have done so much work in the past, that the company should have done so many kilometers of road in the past. Only when the such past actual experience the company has, will the company be able to bid for such tenders, right? So which is a entry barrier for any company. Now
Yeah,
this,
it is popularly called as PQ value.
yeah, exactly. So it's
Correct.
popularly called pre-Q. So I was mentioning the entire name pre-qualifications, but these are pre-qualifications that a company need to adhere to in order to bid for such tenders, which has value. Because if a resolution applicant, so one of the reasons why a resolution applicant could be interested in an infra company would be pre-qualification. For example, if I am running an infrastructure company and there is an infrastructure company up for in the IBC, one of the primary reasons that I could be looking at that infrastructure company could be the pre-qualification that infrastructure company brings on table for us, and hence it has a value. So, however, that value is never captured on the balance sheet.
Yes.
Correct?
Thank you, sir.
I have one additional point just to make and to clarify for the benefit of all. Sir, whenever we are valuing any off balance sheet item, there are two things, sir. One, it has to be specifically sought by the COC or the RP. One. Second, it is not clubbed along with the total value of the other assets. For example, if the already appearing on the balance sheet assets value is hypothetically 100 rupees and the value of the pre-qualification hypothetically is 20 rupees, we will not sum it up and tell that the total value is 120, because the decision which has to happen for the resolution or liquidation will not happen on this additional value. However, this additional value is used by the COC primarily to negotiate and renegotiate with the resolution applicant. So our report mentions value is 100 of the balance sheet items, and additional off balance sheet item hypothetically value is 20 rupees. That is how the report mentions, sir.
Correct.
Okay. Thanks.
Thank you, Sahil. One of the questions that I see on the chat box is, have we valued any intellectual property right in case of CIRP and liquidation? Yes, we have. In fact, a while back we were discussing about brand valuation of a company which has created brand over a period of time. Brands are IP rights of a particular company. We have done IP valuation in both fair value scenario as well as liquidation value scenario. Next slide.
Vineet,
Aji.
Sorry, Vineet, if you can also address the mining rights and
Yes, I was coming
valuation of mines.
Yeah, I was coming there.
Thanks.
So another intangible that we have valued is, say, a mining right. So mining right, again, the mining asset appears on the books by way of the payment that a company has made in order to acquire such mining rights. However, as opposed to that, the value of the mining rights could be substantially different than what is appearing on the books. It would depend on the reserves of a particular mine. It could depend on the extent of the license period. It could depend on what are the going rates of such the mined product at the current rate, and we take all these factors together in order to arrive at a mining right, as opposed to the money that is paid to acquire such mining rights. Do you have anything to add here, Sahil?
Yeah, so just to put it numerically and just to give an example, say hypothetically, say we are buying, say one mined part from market at say 100 rupees, right? And today when I have my own mines, and because of that my part of that component is say 60 rupees, and from that I will also add to it the cost of extracting that component. Ultimately, if it comes to my hand, landed, that cost is 180 rupees, for example. So balance 20 rupees is my value of that mine, because if I go to the market and buy it, it is 100 rupees to me. But since I own my own mine, and the cost of production and mining ultimately to me comes to 80 rupees, that balance value of 20 rupees for that entire mine, again, it is not as simple as what it sounds. because a lot of things have to be taken into consideration. As Vineet said, one scenario would be that you have large mines, but your plant is not in a position to absorb those extracts, as well as these mines are not, you can't mine and sell, so they are captive use mines, right? So there are these complications and these restrictions laid down by the government. And substance like nuances also government. So some being that 20 rupees basically is the value of that mine. That is how we would have to pull in straight simple language, Vineet, if that is correct.
Correct. Absolutely.
That means it is a Habu approach, kind of a Habu approach, highest and best use. Okay.
Correct. One of the case law that comes to my mind here is a case law of Emerald developers. It was specific to mining right itself. What had happened in the instant case was there was a mining right that the company owned in the state of Karnataka, wherein state of Karnataka cancelled on the company moving or admitted to the IBC. The state of Karnataka cancelled the automatic extension of the mining right, and the mining rights were cancelled. To which RP went to the AA adjudicating authority, in this case NCLT, that since the company had been admitted to IBC, moratorium was in place, and that the state of Karnataka was not correct on part of state of Karnataka to cancel such automatic renewal of the mining right. Which case was again taken to Supreme Court, where Supreme Court clearly mentioned that state of the decision taken by the state of Karnataka to cancel the mining right could not be challenged at the AA level, and it had to be challenged either at the High Court level or the Supreme Court level. That was one of the case. That was one of the judgment of the Supreme Court. Also, it mentioned that wherever public there was specific word public asset was in place. In such case, NCLT does not have the jurisdiction to pass as any judgment, and it was ruled in favor of state of Karnataka. Okay, we move ahead with respect to the investment in subsidiary. This was specifically raised by Atulji. Am I right, Sahil?
Yes, Atulji raised it, and more specifically, you want to understand as far as the real estate sector is also concerned.
Yeah, so that you can take up. I think so. We have this point in discussion. Now, when it comes to valuing an investment in subsidiary, in fact, we would divide investments into two clear parts: investments in subsidiaries and joint ventures, and investments other investments. Right now, wherever there is an investment in subsidiary or joint ventures, we have what we need to understand is we need to understand the business of the subsidiary, whether the business of the subsidiary is a going concern. We do ask for a lot of information like audited and provisional balance sheet on the latest audited balance sheet, as well as the balance sheet on the CIP date. In most of the cases, we are never provided for the balance sheet on the CIP date of the subsidiary, for the reason that it is the holding company which may be into which may have been admitted in the IBC. However, the subsidiary company may still be a going concern and is not expected to prepare balance sheet on the insolvency commencement date. So in such case, we rely on the latest audited balance sheet of the subsidiary that is provided to us. We study whether the business of the entity is a going concern, whether it is EBITDA accretive, whether it is profit making. If it is EBITDA accretive, if it is profit making, we try to understand if we ask for future projections in order to apply for income approach for such subsidiaries. If such information is not available, in which case we try to put in place comparable companies method or market approach in order to arrive at the value of such investment in the books of the holding company. And if such information is also not reliable in such case, then we look at the audited balance sheet and value it on the NAV basis.
We need just to add over here specific to real estate. So wherever there is a holdco and wherever holdco has made investments in land holding companies, what we do, and to answer to Atulji, is that we value the underlying asset which is sitting inside the subsidiary company, and then we look at first the adjusted NAV at the subsidiary level, and then we look at if there are any further loans advanced by the parent company to the subsidiary, and then net that off, and then whatever balance amount is remaining after adjustment as per the waterfall mechanism, then that specific amount is attributable towards that investment by the holding company into the subsidiary company.
Actually, sorry, if you are valuing any investment in subsidiary, so what I understand that there is only three approach: income approach, or market approach, and cost approach. So if the share is being valued, so if we are following three approach, then there is no question of breakup approach by removing this advances, intercompany transaction, intercompany sale, because you are going to get the independent kind of thing, independent projections, independent comparable. How it will be justifiable that intercompany transaction or balances should be knocked off in order to arrive the breakup value? Breakup value is something it is not, I believe, not in practice now.
No. So what Sahil was mentioning, Sinaji, here was, so for example, in an instant subsidiary, there are three transactions on the balance sheet of the subsidiary: investment in the equity share capital of the subsidiary, X value. The holding company would have advanced certain loan which is lying as loan in the books of the subsidiary, Y value, and there is some other transaction also where the holding company has to recover an amount, say by way of a advance of capital nature, which is lying in the books of the subsidiary. Now when we are, so as a process, what we do is we first try to arrive at the value of the subsidiary. So for example, the value of the subsidiary is say 100. We first allocate that 100 to the loan and to the other advances, because as per the normal waterfall approach, the equity shareholders will receive the money last. So first we will apply the money towards loan and towards the any other advances that are lying on the books of the subsidiary to be paid back to the holding company, and then the balance money, whatever is left, is applied towards the investment in the equity share capital of the subsidiary. That is the waterfall approach that we generally follow.
I am talking about a scenario where it has been valued in the going concern assumption. Suppose I have a three transaction in the balance sheet. One is the investment I did in the subsidiary. Another is the intercorporate loan. There are two transactions there. Both are appearing in the asset side. So when I am talking about investment need to be valued separately, and loans and advances need to be valued separately. Am I right? Because they are two different financial assets.
Correct.
You are correct. This discussion is only on the premises where the holding company has been valued in the going concern basis, not on the liquidation premises. Correct.
So I will park that liquidation valuation separately, because it is a bone of contention in most of the valuations that we carry out. But yes, in fair value scenario, you are absolutely correct. Equity share investment in the equity share of capital of the subsidiary will be valued separately, and the intercorporate loan appearing on the balance sheet of the subsidiary and on the asset side of the holding company will be valued separately. However, you will appreciate the fact when we arrive at, so for just to let me again give you an example. For example, the overall asset of the subsidiary is on the books is 100, okay, divided into liability of 60 and capital of 40, okay. Now when we value the subsidiary, this 100 is, as per our valuation, the asset of the subsidiary is not 100 and the asset of the value the subsidiary is say 50, correct. Now when the asset of the company is 50, we will allocate 40 as loan out of this first 50, and then balance 10 will only be allocated towards the capital against the equity share capital, because it is a normal waterfall approach, right? Am I correct? On the in the opposing case, if the value of this 100 asset is say 200, in which case we will apply only 40 towards liability and 160 towards the equity share capital. Correct? So that is how the valuation needs to be.
Understood. Thank you.
Yeah. So a couple of points that should be, in my opinion, that should be discussed is, now in case of a subsidiary, say for example there is a subsidiary which is into business on account of a specific contractual arrangement with an XYZ company. On the insolvency commencement date of the holding company, that contract was alive and the company was a profitable company. While the IBC was in progress, the contract of the subsidiary got cancelled. Correct? Now there are two valuation standards that I'm trying to bring in fray. IVS, International Valuation Standards, and the valuation standards issued by the Institute of Chartered Accountants of India. Now, as on the date that we are carrying out the valuation, there are two dates. One is the date insolvency commencement date, and one is the date on which we are issuing the report. As on the date of the issuing of the report, the contract of the subsidiary has been terminated. So technically, it has no value now. The value of the business has gone down to zero. However, as on the insolvency commencement date, there was value in the business of the subsidiary as going concern. Correct? IVS specifically mentions that we need to value the assets of the company as on the date of the valuation and need not consider subsequent events, in which case we need to avoid such contractual termination in order to arrive at value as on the valuation date. However, valuation standards issued by Institute of Chartered Accountants of India do mention that we need to take care of the subsequent event that would change the value of a company on the valuation date. So these are the challenges that we face, and what we have noticed is also because IBBI has also not very categorically mentioned whether we should use international valuation standards or valuation standards issued by the Institute of Chartered Accountants of India. Also, the complications arise in a case where the valuation standards issued by Institute of Chartered Accountants of India are applicable to the valuers being part of the members of ICAI RBO. So valuers who are part of any other RBO need not follow ICAI valuation standards. So in such scenario where we have two valuers who are part of different RBOs could come up with starkly different valuations in case of such scenarios. Investment in Sweden. Again, one of the things that we have noticed, we heard Sahil mentioning that in case of a corporate debtor where balance sheets of the corporate debtor were not prepared for past couple of years, before the commencement of the insolvency, in such a scenario, there was a investment in a subsidiary which had gone defunct, and the company's name was also struck off from the registrar of the companies. However, the financial statements that were provided to us, basis whatever information was available to the RP, such investments did form part of the assets of the company, which we realized as we moved ahead that such a company was already defunct prior to the insolvency commencement date. Obviously, in such scenario, the value of such investment in subsidiary would be nil. However, as RP, we believe such investments should be taken out of the balance sheet before the balance sheet is provided to the valuer. One more important point to discuss here in case of shares of a listed entities. We have noticed in one of the case where the shares, the company had investment in a subsidiary. The subsidiary was a listed entity. As a normal practice, we would value the company based on the market price approach of such subsidiary. But one cannot blindly rely on the market price of the subsidiary. One needs to take into consideration the trading of such entity, whether the shares of such entity are thinly traded, whether how much portion, what is the float of shares of such company on the stock exchanges in order to arrive at the valuation. If the shares of the company are thinly traded, there are possibility that the valuation of such company could be manipulated, and hence in order to arrive at valuation of investment in a subsidiary which is a listed subsidiary, one needs to take this into consideration, whether the shares of such companies are widely traded or thinly traded, and what is the float of such company on the stock exchanges.
Vinitji, one question in this regard. If the shares of that listed subsidiary are suspended, the trading of share is suspended by SEBI, say before 6 months, then what value shall we take? Shall we take the latest value as of the date of suspension, or it has to be by some other way?
No, then it has to, we have to either do a market approach or an income approach. We can then not rely on the market price of such suspended security.
Okay, thank you.
Also, I would let me ask you a question here. So if I was to value a subsidiary and the valuation date was say 31st March 2020, and such listed security was widely traded, and we do not find any other issue. Do you think we should value the company basis the market price prevalent on 31st March of 2020?
Normally, that is the approach where it is traded, and if it is widely traded, then the market price should be the base. But I don't know about your perception.
So here, why I specifically mentioned 31st of March 2020 is it was during that period that the lockdown was announced in India, and the markets were extremely volatile. In fact, they were not volatile; the markets dipped drastically. So in such cases where markets are extremely volatile, or where the share price of a particular security is extremely volatile in that period, or there has been an instance which has resulted into remarkable movement in the share price and overall market sentiments, in such a scenario, what we would generally do is we would study the 6 months or a year pattern of such market price of such listed security and try to arrive at an average price in order to arrive at a value of such listed subsidiary, because as on 31st March 2020, there has been an external event that has substantially may have eroded or enhanced the value of a particular security, which may not be the actual scenario.
Yeah, that is I think for buyback also the similar guidelines is there in the SEBI of taking the average value of last 6 months.
Correct. So that is what we apply. So whatever we discussed for investment in subsidiary, what we have also noticed is we have noticed investment in a partnership concern. So whereas a lot of information for a company is available in a public domain, but in case of investments in capital of a partnership concern, we do not get such kind of information in public domain. Also, we found in case where the CD, corporate debtor, is not supporting and not providing relevant information of such investments, then how do you value such investment? In such scenario, we have no other choice but to fall back on the audited balance sheet and value basis the capital that has been, or NAV as has been disclosed in the audited financial statements of the partnership concerns.
Similar may be the thing for LLP valuation, right?
Correct. Similar will be thing. But LLP, you would get balance sheet on at least on the MCA website, and there will be some public domain information. But partnership, specifically partnership under Partnership Act 1932, there will be no information in public domain. In case of any other investments, which is not an investment in a subsidiary, say an associate, we would more or less follow the similar pattern. However, in most such cases, because they are an associate, information of income or EBITDAs are not forthcoming, and in such a scenario, we do fall back on the audited financials and value it basis the NAV, unless it is a listed company. If it is a listed company, then we have one more approach, which is a market approach or an income approach.
Vinitji, actually, this is a major challenge. What valuing the any investment which is not a listed investment privately held, because as on date where we seek a information for this discounted cash flow method of value. This enterprises value arriving of whether it is a partnership firm or whether it is a company. So who will give the projection? Because the board of directors has been suspended. They will not have any say whether you are getting, not getting. So ultimately, whole thing is boiled down to the RP. So RP is not in position, I believe, to make a projection and give it to you, and you will value. So this kind of thing, while valuing this investment, in case of going concern is a major challenge for us.
Absolutely, you are absolutely right, sir. And whereas you hit it on the nail that the promoter directors have been are being made defunct, and the RP who's now the management. And in case of subsidiaries or in case of associates also, we have seen that the management of such subsidiaries or management of such associate will not they will not follow the instructions of the RP. They will not support the RP in any which ways with respect to the information. In such a scenario, as I had mentioned in the past, we do caveat it, and we have nothing but to fall back on the audited financial statements, because such audited financial statements, if are available on public domain. So we have also encountered a situation where audited financial statements are not provided by the RP, because RP has not been able to gather such audited financial statements from the management of such subsidiary or an associate company. In such a scenario, we have downloaded financial statements from the MCA website and then based our valuation based on such information that is available in public domain.
But who will give the projection? This is the historical kind of thing, no? Projection. How we will arrive on the historical financial basis the projected cash flow?
No, so projections will have to be provided by RP. In case RP cannot provide the projections, we will have to then rely only on the audited financials. If RP cannot, and I understand the practical difficulties that the RP would face, because RP would not know the business of the subsidiary or the associate, and it will be difficult for him to draw out a projection, and hence he will have to rely on the corporate debtor in order to get such information. And if the corporate debtor is not adhering, then we have no option but to rely on the audited financial statements.
Then market is the only approach left, I believe.
Yeah, that is the only approach left. Absolutely.
Yeah, thanks.
Thank you. The other line item would be the long-term and short-term loans and advances, where loans are given or capital advances given for acquiring of capital assets or security deposits. Let me handle the loans given part. These are the line items where we have found it extremely difficult to gather information from a CD. What we primarily get is breakup of the loan. We seldom receive the purpose of the loan or the loan documentation, or whether what was the time period or the terms and conditions of receipt of such loan. We seldom get such information. In such case, we primarily rely only on the breakups that are provided. the aging of such loans, and probably the law of limitations, and then base our analysis based on such basic information that are available in order to arrive at a valuation. Same is the case for capital advances. Capital advances also we seldom receive we seldom receive the POs or the agreement copies or the contract copies in order to understand what is the recoverability possible out of such capital advances, whether the RP could legally challenge the recovery of such capital advances, and hence we have to again rely on the aging of such advances. And if such advances are long outstanding, then it would be very difficult to value such advances. Security deposits, here we would like to differentiate security deposits into two. Security deposits are given to utility companies, and other security deposits like renters and others. So security deposit given to utility companies or for rental, we generally value as is, because utility companies generally on their invoices they mention the deposits that are available of this CD. That's a confirmation enough for us to value such security deposit. In case of rental deposits also, we rely on the agreements that are provided to us. However, in case of any other security deposit, again we rely on the aging of such security deposit and subsequent realization, if any. In all these cases, we do understand if there is any subsequent realization and value basis the subsequent realization, and factor that subsequent realization also as a part of our valuation practice. Okay, this is one of the most important and the largest one. Inventory, valuation of inventory. In order to value an inventory, one of the most important factor is identification of such inventory and physical verification of such inventory. What we have noticed, and this is our practical experience that we have had in past, where the CD, corporate debtor, and the subsidiary of the corporate debtor were having plants side by side. Now, when we went for physical verification of inventory, we were being shown, and believe me, both the entities were producing more or less identical products. Now, when we were being shown the inventory, we realized it later that we were shown the inventory of corporate debtor as well as the subsidiary of the corporate debtor. Now, as a valuer, how do we identify that in such scenario, how do we identify that the inventory is of the corporate debtor only? Is a challenge that we face. The other challenge that we have noticed is, say, for example, in the infrastructure companies, where they have inventories lying in at length and breadth of the country. They could have projects being run in different parts of the country, and inventory lying in different parts of the company. How does one plan the inventory verification in such a scenario? What we generally do in such a scenario is we try to sit with the RP and the team of the corporate debtor and understand where is the substantial portion of the inventory lying, and basis such the information we plan our physical verification from the location which has the highest value of the inventory to the lowest, and try to cover the maximum portion of the inventory. Seldom does it happen that we can verify all the inventory, but we try to verify maximum portion of the inventory. One more example that comes to my mind is valuation of inventory which cannot be measured. Let me give you an example here. For example, in a coal company, a coal is lying in a heap. Now, even though as a valuer I go to the site and identify the coal, there are two challenges that appear. How do I measure the coal that is lying in a heap? We could employ measurement techniques in order to identify the quantity of coal lying, but then the second challenge is coal is seldom valued on the tonnage or quantity of the coal lying there. It is valued based on the calorific value of such coal. So calorific value, you would so under the heap of a coal, you could have a portion of a coal which is completely rubble and may not be usable. So even if you have measured, but how do you identify the calorific value and give value to such inventory item? In such a scenario, we obviously we have relied on the estimated calorific value that the company has, the information that the company has in order to value, but that's a specific challenge that we have faced. When we carry out inventory verification, the date between the inventory verification and the insolvency commencement date are two different dates. We seldom receive the rollback checks in order to arrive at the inventory as on the valuation date. We would have identified the inventory as on the date of verification, but reconciliation between the verification date to the valuation date is seldom available, and hence here also we have to work around basis the basic information that is made available to us of the say production and estimation of consumption basis the production that is made available to us in order to arrive at the value of inventory as on the valuation date. In case of one more case that comes to my mind is in case of an infra company which has projects at multiple locations. There might be a situation that the inventory is lying at a client location. Subsequently, client has terminated such contract, and the inventory is still lying at the client location. When the contract is terminated, the possession of inventory is still with the client. How do you value such inventory? That where the possession of the inventory is not with the CD. Possession of such inventory is with the client of the CD, and there are various litigations or cases that have been filed between the CD and the client. In such a scenario, if as a valuer we come to a conclusion that the litigation value is substantially large and it is impracticable to take control of such inventory, then we would not value such inventory. However, if it is other way around, if we believe that there is a way to take control of such inventory, then basis such we will put a value to that inventory in our valuation report.
Yeah, in addition to whatever you said, I can say that much that even though there are certain if that inventory is lying with the client places, and there are some labor claims which are locals over that area, which will not allow you to move that particular inventory unless their dues are paid.
Correct.
So that is also top of it, on top of
Correct.
it.
Correct. Absolutely right, sir.
And sir, Vinithji, one similar example is there where the company is doing third-party production and inventory is lying at the vendor place.
Correct.
And this is another challenge.
Correct. So that is also a challenge for RP. How do you take control of such inventory?
Vinithji, one more thing I want to know, this in case construction contract, as per the accounting standard, we have to recognize construction work in progress. In the balance sheet item, there is a huge amount of construction work in progress in case of real estate company, in case of infrastructure, whatever, where the accounting standard relating to construction contract is applicable. So under which head it is falling? It is falling under, do we as a financial asset, do we need to value, or it will be valued by the land valuer or plant and machinery valuer?
So that's a brilliant question, sir. In fact, thank you for bringing it up, because I think so we have left this in our presentation and we'll add it when we do it next. So what we generally do here is we would like to divide it into two. If it is a real estate project, then we are a RVE, registered valuer entity. So what we do is, if it's a real estate project, we rely on our land and building valuers to help us with the valuation of such real estate in work in progress and other assets. However, in case of pure projects companies, say for example road project company, or for example airport projects company, infrastructure, for that matter, infrastructure companies. In such case, in fact, we ask for a very detailed project analysis from the RP and the CD, which will have project-wise information of the total contract value, the total completion as on the date of the insolvency, total completion from the insolvency, what is the money that has been received, how much of the value is carried in the work in progress, how much has been billed, and basis such detailed analysis of single individual project line, we put value to the work in progress, the unbilled revenue, or to the even to the debtors, and for that matter, let me not forget the security deposits or retention monies lying with the client, and the security performance deposit lying with the client. So all of this is analyzed together in order to arrive at a value, because none of them can be analyzed individually and given value.
Okay. So are you following same principle, proportionate contract completion basis? So the formula is revenue into cost incurred till date divided by estimated cost of production, kind of such kind of thing.
Yeah, so
where
that
we are as a
sorry, continue.
Where as an accountant we are following to recognize construction WIP. The formula is the total revenue into cost incurred till date divided by projected cost to complete. What is the proportion there? We will recognize in the balance sheet.
Correct.
The same principle you following.
So same principle is followed by the CD. What our work is to understand the recoverability of amounts lying on the debtors in the retention portion. So there may be a reason that the corporate debtor may have valued debtors, which means the receivable, on a higher side, because he thinks because as per the calculation the receivable would be higher, but that calculation is only with respect to analyzing that particular line item of a project. Our thought process when we are reviewing a project is we also try to understand what is the status of the project, whether the project is currently in progress, whether it is stalled, whether it is terminated, whether there is some dispute. We try to understand what is the communication that is happening between the company and the client, and try to gauge if there is we also call for information if liquidated damages are going to be implemented by the client on the company. And basis such complete information on every project, we ascribe a value to the debtors, to the retention money, to the security deposit, and to the inventory.
Okay, thank you, sir. Thank you.
Yeah, thank you, sir. So thank you for reminding me. Actually, we did not put that in this particular slide. We'll put that. So inventory at third-party locations, so that has been identified. So this is about the inventory. These are the challenges that we face while valuing the inventory, and how do we resolve such challenges that we face while valuing the inventory. With respect to trade receivables, again, the basic information that we call for is the party-wise information, what has been their payment profile, whether they have been paying up on time, whether there has been any delay in the payment in the past, what is the aging of such debtors, is there been subsequent realization on such debts? Is there any disputes with the debtor recently in the recent past? If there is a dispute, what is the kind of dispute? And we try to call for legal opinion also on such dispute if possible. If legal opinion is not possible, then we try to frame our opinion on the dispute that is there. And this is such information that is made available to us. We ascribe a value to individual debtors. So this is the kind of analysis that we carry out while valuing trade receivable.
Yeah, here also there is a model called ECL, expected credit loss. So that also one has to provide for that is receivables.
Correct. And the next line item is pretty straightforward, which is the valuation of the bank accounts or the short-term deposits or checks in hand. Here, the only couple of things that I need to bring into your attention is seldom do we receive the cash holding certificate from RP, because most of the time we understand that RP does not receive the cash that is shown on the balance sheet in hand, and hence we never find that cash holding certificate from the RP, which makes it more difficult to value the cash. the third line item, or sorry, the fourth line item, which is the margin money deposit with the banks. Here we try to identify the purpose of such margin money against the underlying contracts. We try to understand what is the underlying contract under which such margin monies have been given. What is the possibility of such contract going bad if the margin money has been given under the as margin of the BG, whether there is a possibility of revocation of BG, if there is a letter that has been received or communication that is received for such revocation, and then try to put a or ascribe a value to such margin monies. In fact, here there is a case law that comes to my mind with respect to an ICICI bank, where subsequent to the CD being admitted under the insolvency, the bank had debited certain charges and also invoked the FDs against the BGs that were invoked. The matter had come up against with the AA, and it was specifically decided that the ICICI Bank will have to refund such charges, and the FD that was debited against such invocation, which was subsequent to the admission of the debtor in the insolvency process. Taxes paid and balance with revenue authorities. One of the biggest contention with respect to the taxes paid we have noticed is valuation of deferred tax assets. In our opinion, when we value a company as going concern, such deferred tax asset definitely has value, because we believe there will be subsequent cash realizations at EBITDA and profit level, which will result into the recovery of such deferred tax assets. The only challenge would be when would such deferred tax asset be realized, and we basis our judgment and the information that is made available to us, we put a specific discounting on the year in which we expect such asset to be realized in order to arrive at the value of such DTA on the insolvency commencement.
Sir, we need the one last question, sir.
Haan,
one last. See, I actually a little bit confused when a company under CIRP is going to be valued on the basis of going concern. So one approach is there. I will value as a enterprises value as a total, not going on the component wise. What is the asset, total asset, and making it total. I will value the enterprises value, and I will arrive at valuation. Another approach, what we discussed right now, the component, every balance sheet single item need to be valued. So in case which approach we should follow, where the case is to be valued at a going concern, as the enterprises value or individual asset wise value.
So let me ask Sahil, because this specific question was answered by Sahil a while back. Let me ask Sahil to just answer that.
Missed that.
So, yeah, basically it's sum of parts. You need to value the assets, and valuation of the assets in a fair value. Going concern fair value need not be the enterprise value, sir. Right? It only means that these assets will continue to operate in the same location required for the same reason and the same sector, and will be put to the same use, and not valuing it by its at its enterprise value by accounting for its discounted cash flow. So by a going concern fair value, we don't mean by doing an enterprise valuation per se, but we mean that it will be assumed that these assets will be put into use for the same specified purpose in a going concern scenarios.
Okay, so individual assets need to be valued.
Right, sir. Individual assets, sum of parts, totaling up to the fair value.
Okay. Thanks.
Thank you, Sahil. Thank you, Sinatra. Okay, so with respect to taxes, this is one of the contention that we have regularly faced, whether to value DT or not. Other line items are straightforward, and I'm not getting into detail because we are also running out of time here. In the second line item, which is balance with the revenue authorities, let me straight come to one of the important cases that have come to us, where we see subsidy receivable being accounted as an asset, and whether and how to value such subsidy receivable. The practice that we have been following is understanding the enactment under which such subsidy has been applied for, trying to understand the where the application of such subsidy is lying, whether it has been approved by at the respective department level. If it has been approved at the respective department level, then the full value is generally accorded. We only provide discounting with respect to the judgment of the recoverability. So there is a chance that the subsidy has already been approved, but the recoverability of subsidy may happen 1 year or 2 years down the line, and hence the value of a subsidy 1 2 years down the line may not be the value that is been carried in the books. So for such we provide discounting of time value money discounting in order to arrive at the valuation as on the insolvency commencement date. We also try to understand. So we primarily do not only value it at the asset level that has been shown in the balance sheet. We try to understand the enactment under which it has been applied, the stage and the stage where the application is lying, whether it has been approved, what is the chances of the approval of such subsidy, in order to ascribe a value of such value to such subsidy. I think so. These are similar line items. Okay, input tax. Okay, this is a okay. Thank you. That's a good question, Suresh ji. So input tax credit in the books of the company, we do value the accord of value to the GS input tax credit for the purpose of the valuation in the going concern, both under fair value and the liquidation value scenario. However, if we are valuing the company under piecemeal basis, liquidation value under piecemeal basis, in such cases, GST is not given value. Your question is input tax credit in the books is different from figures shown in portal, say less in books and more in portal. In such case, which value will be considered? We generally ask for reconciliation between such values. If reconciliation is not available, then we will rely on the portal figures.
Thank you.
Vinit ji, if you have completed, may I ask a question?
Yes, sir. We are done.
Yeah, I've got two questions. One is for you and one is for Sahil ji. For you, just wanted to ask whether contingent liability, do you take into consideration for valuation purpose or not?
No, sir. We do not take any liability into consideration because
contingent liability.
Not even contingent liability.
Okay.
So okay, let me slightly reframe that. I'm sorry.
They are not taking liability also. How will they take contingent liability also?
If that contingent liability will have a bearing on a particular asset, for example. So let me give you an example. If there is a BG, like I mentioned a while back, if we receive an information that a BG might be invoked, which would have implication on recoverability of such debt lying on the books, then we would look at such debt. We would not give a one-on-one value. So जितना invoke होने वाला है वो पूरा ही debtor के सामने से minus कर देंगे, ऐसा नहीं होगा. But we will take cognizance of such information in order to arrive at value of such debt.
Okay, thank you. Sahil ji, may I ask you a question?
Please go ahead, Hemant ji.
Yeah. So there is a scenario like the building of 100 crore is standing on a leasehold land. Now, leasehold land period is 60 years, which is renewable after 30 years from the local authorities. So the 30 year has expired and now renewal is required, but it has not been renewed. I guess you can understand about which case I am talking about. It is in the heart of the city. So how will you value that leasehold land? Because it is actually having a zero cost, not in the balance sheet of the corporate data. Only building is standing on land, which is having 100 crore of, which has been, the company has already built up a 4-star hospital, 5-star hospital on that.
Yeah,
So
I understand, sir. Great question. Good that you brought it up, sir. And we have seen this across a lot of asset classes, may it be industrial or may it be other put to commercial use also. So there are a couple of things to be considered here. One is that to break it up into it specifically mentions upon the type of lease. Now, if the lease has a renewal clause, and usually they have seen in the past that they are perpetual or perpetuity in nature. Like, say for example, a lot of industrial estates in southern India, say in Karnataka, have a lower tenure of the lease. Say they only have a 10-year lease, 5-year lease, 15-year lease. However, the plant life is substantially higher than 5 years or 10 years. So in that case, a valuer may check what is the practical renewability of that lease. And if there is enough comfort that the lease will be renewed, or there is a provision to renew that lease, then he might take a life to the extent of the total economic life of the total balance life of the assets. However, if there is a situation and scenario wherein the renewal of that lease is challenged, and then in that case the valuer will only have to take the balance economic life of the lease to be taken as the balance economic life of the assets constructed thereupon. So that may be applicable for a commercial, that can be applicable for an industrial also. That there is an industry on a leasehold land, balance hypothetically has 10 years, and although the plant can live for 15 years, 20 years, but the total assets have to be valued considering total balance economic life of 10 years only. In that case, if there is no renewability allocated to that.
Thank you, Sahilji, for replying that question. I just request the audience to ask a last question to the speaker. Then we can conclude this session. Any
What
question?
about goodwill books of account, sir?
Vineet, would like to take up goodwill?
Sorry, I couldn't hear. Goodwill.
Goodwill.
So goodwill would be similarly valued. So goodwill is again an intangible asset. So goodwill either would be valued basis the cost, or basis the market approach, or basis the income approach, as was discussed with respect to the brand valuation. However, if a goodwill is marketable, then we would carry out valuation under either of the approach in order to arrive at the value of such goodwill.
Okay. So Hemanji, will you give the vote of thanks?
Yeah. So friends, you will all agree that both the speaker of today has spoken from their heart, and they have shared the real life experience which they have faced from IBC point of view, valuation aspect. And both of them are basically they have done a good job in IBC sector, and they have been doing quite a good number of valuations in IBC cases also. So all of you will agree that whatever they share was really worth to as a resolution professional for us to listen to them. And I can say in bankruptcy, if you want to define a bankruptcy, it is a legal proceeding in which you put your money into your pant pocket and give your coat to your creditors. So that is the bankruptcy, and in that particular valuation aspect. So if we just take a number from the balance sheet and value the business of the company, that will not suffice. As said by Warren Buffett, that managers and other people should understand that the accounting numbers are just a beginning, not the end of business valuation. So with these two quotation, and Sahil particularly as a third generation from valuation sector itself has really brought of assets like land, building, and plant and machinery. And Vinit ji has dealt with the the financial valuation aspect very well. And I propose a heartiest vote of thanks from bottom of my heart to both the speakers and on behalf of WIRC and IBC study group. Thank you very much, and we look forward to you for some other session on valuation under pre-pack and sharing experience of that. Thank you very much on behalf of WIRC. Thank you.
Thank you so much.
The video recording shall be available on the WIRC website.
Yeah,
So,
as an initiative to our chairman, present chairman, the video recording of this session and other IBC sessions also will be available on the website. And you can, if you could not attend or your friend could not attend it completely, you can definitely view it again on the WIRC website. Thank you very much. Thank you, friends. Thank you to the speakers also. Thank you very much. Bye.
Thank you for giving us the opportunity. It was a good learning experience for us.
Yeah. Okay. See you again. Bye. Thank you very much.
Bye. Thank you.
Thanks.